that is buying a lot of stuff, the market should go up. You really had no strategy, no plan, no system. You were just shooting from the hip. That's right. Then, over time, I started to get a grip on how to make money. As opposed to saying, I have an opinion and I want to express it in the market, I started asking, how do I make money out of all this? What had you learned by that point? I had learned that an opinion isn't worth that much. It is more important to listen to the market. I became a reactive trader as opposed to an opinionated trader. In 1980, one of my customers was Solomon Brothers. At the time, they were bearish on bonds from 65 to 80. If I had listened to my big customers as I had done in 19,791 would have thrown away money all over again. What told you not to listen to your customers then? The 1979 experience of losing money based on someone else's opinion, a sound opinion by intelligent people that was just absolutely wrong. Where were your successes coming from? I learned how to read the tape and developed good instincts. We were such big players in bonds back then, we, meaning my customers and myself, that the spots we picked to trade could virtually stop the market. We were actually creating some of the support and resistance points. It didn't take that much to do it back then. I think there was a streak of months when I hardly had any losing days. Could you have done it without the commercial accounts? I would hope that I could have done it without them, that it wasn't a self-fulfilling prophecy. But if it was, fine. I don't know. When did that streak end from a trading standpoint? I never had a losing year until 1986, although I did struggle in 1985 during the mid-stages of the bull market in bonds. Was your trading success a matter of being able to read the tape? Yes. I was attentive and had good instincts. It sounds like you are saying that either you are born to be a good trader or you are not. Well, to a certain extent, that may be true. My feeling is that you don't have to be, but it helps. Is it a matter of having a sixth sense about the market? Yes. Your gut often tells you what to do. Are people who don't have the natural instincts for trading wasting their time, or can almost anybody be successful if he or she works at it hard enough? Working hard has nothing to do with it. About 2 weeks ago, a very bright fellow who works for him said, "This is a very frustrating business. It doesn't matter how hard I work. It has no bearing on whether I make money or not. You have to know yourself and put that knowledge to work in the market." That sounds like a cliche. What do you mean by know yourself? I'll give you an example. I think I'm a good trader, but there is a guy working for me who is better. I could go out there and beat my head against the desk and try to outdo him, or I can just be myself. Let him make whatever he can, and I'll make whatever I can. This is my view of a year in the life of a trader. 4 out of 12 months you are hot. You are so excited that you can't sleep at night. You can't wait to get to work the next day. You're just rolling. 2 months out of the year you are cold. You are so cold, you are miserable. You can't sleep at night. You can't figure out where the next trade is going to come from. The other 6 months out of the year you make and lose, make and lose. You can't sleep because you are trying to figure out how you are going to make money. The net result is that you never sleep because you are constantly thinking too much about trading. It is an all-consuming thing. That is why you need to know yourself to moderate your emotions. If you don't, then after a big success, you are high as a kite. You are not prepared when just around the corner the market suddenly brings you back to earth. Or in the opposite situation, when you are consistently losing, you might end up jumping out of a window. Why did I leave the floor again? Because I know myself. I need to interact with people, and that doesn't happen there. Being on the floor sounds like a very intense thing to be doing day in, day out. Does it physically grind you down? Absolutely. You can see that in the older fellows. When you are in your 20s and 30s, you can rebound pretty well from the physical and mental stress. As you get older, you don't rebound as well, and you have to push harder to maintain your performance. It sounds like professional sports. You get to a certain age, and no matter how good you are, that's right. It's exactly like that. Out of every 100 people who go to the floor to become traders, how many will make at least $1 million within 5 years, maybe five or less? How many will end up losing everything they came in with 133, at least half? You have been more successful than most traders. What do you attribute your success to? The reason I have been so consistent is that I'm a great listener. I probably talk to about 25 traders each day. Most traders don't listen to your opinion. They only want to tell you their opinion. I am different because I honestly and truly listen to what they say and how they say it. For example, if one of the major locals calls me up 3 days in a row when the market has rallied, and he is asking me what I think, I know that he has been selling and is not sure of his position. What does that tell you if it is in line with what the other traders I talk to are doing? It tells me the market will probably go higher. So if you talk to 25 people, and 20 of them are nervous about the market going higher because implicitly they are short, does that tell you that you should be trading on the long side? Yes. I know a large number of people in the industry, and that is a big plus. I listen to them. I go with the people who are hot. Sure, I can form my own opinion, but that is not what makes me do the things I do in the market. Sometimes, my opinion is right, and I'll go with it. Sometimes I know somebody else is hot, and I'll go with their opinion. I'm not picky about how I make my money. It doesn't matter if my opinion is right or wrong. All that matters is whether I make money. Doesn't it get confusing when you talk to 25 people and 15 are bullish and 10 are bearish sometimes? But I've been doing this since 1976. I've always been able to read people very well, even though no one thinks I listen. For example, I have one trader here who is cold as ice right now. All I have to do is listen to him. Last night, he told me he wanted to be short. I knew that I was going to be as long as he is cold right, and the one time he gets hot, fine. When the guy is cold, he is cold. You can't say to a trader, "You're cold, you can't trade." You have to let them run their course. Is reading other traders a key component of your personal trading right now? Yes, I'm pliable. I know these people, so I understand how to read them. I don't want to hear what Jack Schwager says because I don't know him. I only want to talk to people I know very well. What other things are important to your trading success? The realization that when you don't care, you do well, and when you try too hard, you don't do well. By trying too hard, do you mean pressing when there is no trade? Pressing is one of the reasons I'm sitting in here with you for so long during trading hours. The markets haven't traded well in weeks, and we are proud of ourselves for not having thrown a lot of money away. So when the opportunities aren't there, you just lay fairly low. Don't misunderstand me. I'm not that good at that, but I have gotten better as I've gotten older. I've learned that lesson over the last couple of years. After Richard Dennis left the floor, he said the first year I left the floor was the most painful experience for me, and I have paid the largest tuition I ever have. It was the same with me. What was the motivation for coming off the floor? Since you were so successful there, I felt that the industry had developed to the point where my brokerage skills were no longer needed. All anyone wanted to know was, where's the next tick? How can I move size? The price to be paid for my particular skills was too low. You are talking in terms of customer business and trading. The market had gotten so voluminous that my style of swing trading was worthless. It got to the point where I was just trying to read the next tick instead of the next 8 ticks. Why couldn't you play the same game? The volume was too big. capitalization was too big. I couldn't read the market from the floor, because there were too many players exactly. In the early days of T-bond futures trading, the depth was low and you could read when people were overextended long or short. You couldn't do that anymore. Did your performance start decreasing? Did you see the handwriting on the wall in 19,851 made under $1 million trading for the first time, and I knew something was wrong. I had always been a very consistent trader, making more money each year. I looked at my results and found that my profits were smaller, meaning 3 and 4 ticks, and my losses were greater. My first reaction was to become a much more active pit trader. I found that I was taking on tremendous positions and the risk reward was insane. That was when I became convinced that I had to make a change. Were you just lucky that you didn't get hit really hard during that period on any particular trade? Actually, I did get hit pretty hard a couple of times, but I had some good winners too. The point is that as I worked harder and harder, I found that all I was doing was running in place. I don't like to work hard at trading, and here I was just mentally and physically exhausting myself. If you had been doing as well as in previous years, would you have stayed in the pit? Yes. The pit is a very stimulating environment. Off the floor, you have to force yourself to be motivated each day. That was a very difficult transition. 134. Is it harder to trade off the floor? Not in the long run. My profitability in 1987 and 1988 has been pretty good. You mentioned that your first year off the floor was very difficult. Was the main problem that you were still trying to trade the market as you did on the floor? Yes, that was the number one reason. The second reason was that the transition occurred during the 1986 runaway bull market. I was bound to lose because my style was not based on following trends. Is that still true? No, it has changed. I've gotten better. I can still counter-trend trade real well, but I found you can also make a lot of money trend following. Do you use trading systems? No, we are discretionary traders. We only use technical indicators and systems as trading tools. One particularly interesting system we have developed is based on quirks related to volatility. Our belief is that volatility offers clues to trend direction. Although we've found through backtesting that this system gives you good signals, we do not blindly follow the trades. For an automated, computerized system, what would you consider good results in terms of average annual return? About 40 to 50%, with maximum equity drawdowns under 10%. But systems will always have larger maximum drawdowns than that. That is why we haven't directly traded money on them. Do you think any system can compete with a good trader? I haven't seen one yet, although there may be one somewhere. There are some traders who have the skills, but who don't succeed. What is it that keeps them from becoming successful? Most traders who fail have large egos and can't admit that they are wrong. Even those who are willing to admit that they are wrong early in their career can't admit it later on. Also, some traders fail because they are too worried about losing. In other words, successful trading is a matter of trying to avoid losses, but not being afraid of them. That is a good way to put it. I'm not afraid to lose. When you start being afraid to lose, you're finished. Is the ability to accept losses a characteristic of a winning trader? Yes. Tom Baldwin is a good example. He only trades the market. He doesn't trade size or equity. By that I mean, he doesn't say to himself, I am long 2,000 contracts. Oh my God, that is too many, I have to sell some. He never looks at it that way. He will sell either when he thinks the market has gone up too far or when he thinks that his position is wrong. In your trading experience, is there one particular trade that stands out as the most dramatic? In 1986, when the long bond was being cornered by the Japanese, there was a big emotional rally on a Monday morning. I had thought the market was too high at 90.0, and here it was trading over 91.0. So I sold 1,100 contracts scale up above that level. The market backed down and was offered 1,000 lots at 91.0. Just as I was thinking that I had this trade nailed, in less than 5 minutes the market reversed and soared to 92.0. I was down $1 million, and the market was only a few ticks away from limit bid. I had never lost so much money so fast, and it was because I did things differently than I normally do. What specifically I usually don't trade that big early in the year. I like to make money gradually at first and then play with the money I have made. It sounds like part of your money management philosophy is based on treating each year independently. Right. Anyway, I sold a little bit more up at the highs, and from that point on I was only concerned with covering. I waited patiently, and the market started coming back down. I ended up losing only $400,000 for the day, not all that bad considering where I was earlier. But that trade had a big emotional impact on me. I was flabbergasted by the market action. I had forgotten that markets could run away like that. I couldn't believe how wrong I had been. What did you mean earlier when you said the Japanese cornered the market? When the Japanese want to buy something, their big thing is market share. This was the first time the U.S. got a good feel of how the Japanese buy securities. They buy them all. Was this the move that drove us to the highs in the bond market? That's right. So, apparently, the Japanese weren't as fazed by the yield being so low for all the risk implied in a long bond position. I don't think they look at it in terms of yield. Rather, they view things as whether prices are going up, and if they are, they buy. Every time they would buy, prices would go up, and they would buy some more. The bond market has collapsed again since then. Did they get out of their position in time? 135 sure. Do you know who bought the most at the highs? The U.S. Dealers who desperately needed to cover because they had sold on the way up. Are the Japanese smart traders then? No, they just have a style. They are cannonball traders. They go one way, and they all go together. A friend of mine at one of the Japanese shops told me about a Japanese trader who bought just about every long bond on the screen. About 15 minutes later, he called back and asked, "Why is the basis the price spread between cash T-bonds and T-bond futures going out naively?" The Japanese trader had noticed that cash prices had gone way up, while futures didn't go up very much. My friend told him, "Well, you just bought every bond available. Of course, the basis is going to go out." They didn't really understand the impact of their trading. The Japanese did much the same thing in the U.S. equity market in 1987 as they did in bonds in 1986. They practically took control of it, buying because prices kept going higher. 11 never forgive myself for not buying stocks and selling bonds in 1987. That was going to be my #1 trade in 1987. Was the reasoning that the bond market had already run way up, while stocks hadn't? Did you just believe the two markets were out of line value-wise? That's right. Also, we knew the Japanese were buying the high capitalization U.S. stocks. Having already learned their buying style in the bond market, the trade was even more obvious. Then why didn't you do it? The spread between the S&P and the T-bond contract was trading between $19,000 and $25,000 on one-to-one contract value basis. I went on a 4-day vacation, and in just a few days, Japanese buying in the stock market had pushed the spread to $30,000. Why didn't you buy the spread before the vacation, since you had the idea I was waiting for the spread to break out above its trading range? I wanted to buy it above $26,000. At a $30,000 spread, I just couldn't pull the trigger. What is the key trading rule you live by? Never add to a loser. What does the average trader do wrong? He overtrades and begs for tips. How do you handle a losing streak? I instinctively trade smaller and sometimes I just take a break. It is a good habit to wipe the slate clean and start fresh. When you are going bad, but still have some good positions on, do you liquidate them as well? Absolutely. They are bound to turn against you too. I found the subjects of dual trading and the Japanese impact on the U.S. T-bond market among the most interesting portions of my conversation with Brian Gelber. These subjects, however, did not provide any insights into the art of trading. On a more practical note, one of the primary caveats provided by Gelber concerned the misuse of brokerage research. He noted a tendency for the broker and client to use longer-term research for short-term trading. This misapplication of information often leads to trading losses, even when the research is right. Clearly, flexibility and suppression of ego are key elements of Gelber's success. Referring to hot traders, he notes, "I'll go with their opinion. It doesn't matter if I'm right. All that matters is whether I make money." Finally, Gelber's reaction to losing streaks is one cited by a number of traders. He advises wiping the slate clean and starting fresh. Getting out of everything allows the trader to achieve greater clarity. Liquidated positions, if they still appear attractive, can always be re-entered once the trader has regained his confidence. 136 Tom Baldwin, the fearless pit trader. The trading pit of an active futures market is an imposing place. Scores of traders push over each other while shouting buy and sell orders at the top of their lungs. To the uninitiated, it seems miraculous that this institutionalized bedlam actually functions efficiently as a process for executing orders. In the frenzied world of futures pits, the T-bond ring, with over 500 traders, stands out as the unchallenged giant. The pit is so large that one side of the ring often does not know what is happening on the other side. By most accounts, Tom Baldwin is the single largest individual trader in the T-bond pit. His trading size puts him in the same league as the primary institutional players. Single trades as large as 2,000 contracts, $200 million face value T-bonds are not unusual for him. On a typical day, he may trade over 20,000 contracts, the equivalent of $2 billion in face value T-bonds. Baldwin is in his early 30s, having begun trading T-bonds a scant 6 years ago. Baldwin's entry into the world of floor trading sounds more like a recipe for failure than success. In 1982, with no prior trading experience, Baldwin left his job as a product manager for a meat packing firm to lease a seat on the Chicago Board of Trade. His stake was only $25,000. Out of this skimpy capital base, he had to pay over $2,000 per month to lease the seat, and at least another $1,000 per month for living expenses. As if this were not enough, his wife was pregnant at the time. Obviously, Baldwin is not one to play it safe. His aggressive risk-taking posture is one of the key elements of his success. He turned a profit from the beginning. He was a millionaire before his first year was up and has never looked back. Although he declines to discuss the extent of his winnings, $30 million appears to be a conservative estimate. The true figure could be significantly higher. I considered an interview with Baldwin essential to this project because of his prominence as the most successful floor trader in the world's largest futures market. Baldwin, however, was not eager to be interviewed. Although he had done some interviews in the past, he had obviously grown reluctant to do any more. Without Brian Gelber's generous intervention, the two are friends and admire each other's trading abilities. This interview would never have taken place. Gelber had warned me that Baldwin could be either abrasive or gracious, but to be prepared for the former. As an example, Gelber said that Baldwin would probably answer the question of how he first got involved in trading with the curt response, "I went down to the floor and began trading." As it turned out, this was very close to the spirit of his answer. I arrived at Baldwin's office several minutes after the end of the day's trading. Baldwin arrived a few minutes later. Since he had just moved to new offices and the furniture had not yet been delivered, the interview was conducted sitting on a window sill. Baldwin's attitude was neither abrasive nor gracious; aloof might be the best way to describe it. I had the distinct impression that the minute I hesitated in asking the next question Baldwin would be gone. It was St. Patrick's Day, and this impression was intensified each time someone left the office saying that he or she would meet Baldwin at a local bar. I could sense that Tom was anxious to join them. I decided to conduct the interview completely impromptu, shooting off a new question the second he finished answering the prior one. Often his responses were quite short. I felt like a photographer stalking a rare bird. One false step and the bird would fly off. I knew that at some point I would not be able to think of an immediate follow-up question. This happened about 40 minutes into the interview. I quickly glanced down at my index cards, searching for a lead. Unfortunately, my eyes focused on a question I had already touched upon, and though I tried to ask it from a different perspective, it was too late. The game was over. Baldwin said he had to get going and excused himself. "How did you first get interested in trading?" I had taken some classes in commodities in graduate school. "I wanted to trade, but I didn't have the money to buy a seat. In 1982 one found out I could lease a seat, and that's when I began." "Did you always want to trade as a local as opposed to any other type of trading?" "Yes." "How did you learn to trade one lot at a time?" "I always had an opinion. All day long I stood there and developed an opinion. As I came to see that my opinion was right, I was reinforced even if I didn't make the trade. Then when I traded, I knew from standing there 6 hours a day, every day, that most of the time I was right. I would see the same scenarios develop over and over again." "Are you talking about market patterns or traders doing certain things?" "Both. Market patterns would occur over and over again, or market players would do the same thing over and over again, and you just trade it." "What were your first few months like? Were you profitable?" "I think the most I was ever down was 19 ticks, so I pretty much started out profitably." "Coming to the pits with no background, what was it that gave you enough of an edge to be right on the market?" "I worked hard. I stood there 6 hours a day, all day, every day." "But you didn't have any experience to fall back on." "You don't need it. You don't need any education at all to do it. The smarter you are, the dumber you are. The more you know, the worse it is for you. For your type of trading, that is, scalping when you put on a trade, what are you looking for? To get as much as I can get out of it. I've taken full points or just one tick out of a trade. You just never know. You have to watch the market, get a feel for it, and if you are in the right position, just go with it. 137 on average, though your trades will net out at a few ticks, yes. I probably average 4-tick profits on big positions." "I assume your holding time is probably very, very short." "I try to make it short." "Are we talking about minutes?" "Yes, or seconds." "Just because that is less risk." "The object is always minimize your risk." "Have you always been a scalp type trader?" "Well, I evolved from a pure scalper to a combination of scalper and speculator." "Right now, what percentage of your trades are position versus scalp?" "A small percentage, well below 10%. "Basically, then, you are still using the same basic trading style Jan started out with." "Right." "Do you use any technical input?" "Yes." "I use charts." "Do you use intraday charts?" since you are trading short-term, no. Bar charts covering the past 6 months. If you look at the charts and say, I'm basically bullish, do you primarily scalp from the long side? Not necessarily. I would start with an opinion, but if I saw something to change my mind, I would adjust. Is the fact that you started off with a chart influenced trading bias a key element behind your winning? Yes. Were there periods when you were unsuccessful, or did you remain consistent? Didn't you have any losing months? Yes, I had one or two, but not two together. No, never. What percentage of those who come to trade on the floor are still around after 5 years versus losing their stake and dropping out less than 20%? That is really the rail of thumb, and it's probably less than that. What percentage are successful to the point of making and keeping at least a couple of million 1%? In other words, a very small fraction of traders. Right. It is like any other industry. How many people get to be president of General Motors? Do you have an opinion about what separates the 1% from the other 99%? Yes. It is a lot of hard work, for one. It's perseverance. You have to love to do it. Also, in our business, you have to have a total disregard for money. You can't trade for money. Do you mean as long as you like the position, you stay with it, that you can't think, I'm losing $1 million on this trade, and with $1 million I could have bought a great house? You can't translate it into real terms. Exactly. Most people do. I guess another way of saying it is you have to have almost no fear. Right. Is that a characteristic of winning traders? They have less fear than the losers, yes. Can you size up a new trader on the floor and tell if he is going to make it or not? Yes. What kind of things would tip you off that he is a loser? Most important, losers don't work hard enough. Most people walk in and think there is a 5,050 chance on any trade. They don't think there is anything more to it than that. They don't concentrate. They don't watch the factors that affect the market. You can see it in their eyes. It is almost as if there is a wall in front of their face. By factors, do you mean fundamentals? No. Paying attention to what other markets are doing, such as the Dow Jones or gold. Watching the traders in the pit. Patterns, yes. 138, in other words, they are not paying enough attention. They are standing there trying to pick a trade here and there, but they are not absorbing everything that is going on. Right. Also, their expenses are usually way too high. They can't stand there and hack it long enough to pick it up. Because it is like any job. If you stand there long enough, you have to pick it up. It is just a matter of how long you can afford to stand there before you do. Do you really believe that? Well, the average guy might not be $1 million trader, but if he stands there for 5 years, he would have to pick it up. It is just like a job. You don't start any job and feel comfortable in the first 6 months. You did. Yes, but I did start as a one-lot trader, and I wasn't really comfortable because I had to make money. I only had $25,000 to my name. At what point were you confident that you were going to be successful at it? That is an interesting question. You are never really confident in this business because you can always be wiped out pretty quickly. The way I trade is live by the sword, die by the sword. There is always the potential that I could get caught with a big position in a fluke move with the market going the limit against me. On the other hand, there is no doubt in my mind that I could walk into any market in the world and make money. What percentage of your days are losers one day, out often? Has that percentage changed over time? That is, over a long period of time. From your perspective, what does the average trader, that is, public trader, do wrong? They trade too much. They don't pick their spots selectively enough. When they see the market moving, they want to be in on the action. So they end up forcing the trade rather than waiting patiently. Patience is an important trait many people don't have. Waiting for the right spot right. I bet most people are probably ahead after their first 5 trades. They think this is great, like free money. But then they forget that the reason they made money on their early trades was because they waited a long time. They said, I bet this is a good spot to buy it because I've seen the market act this way a lot of times. And they made money. But all of a sudden, they are doing a trade every day. The next thing that happens is they lose on a few trades and invariably don't know how to take a loss. They made money to start, and before they know it, they are even. Now they hesitate. Where do I get out the minute they hesitate? The market just keeps going. Now they are losing money and they say, if I sell it here, I'm going to lose $1,000. They don't like to lose $1,000 when they are getting paid $500 a week. Now, all of a sudden, they are thinking about the money. Once you think about the money, you are dead yes. That is what usually happens to the public. What is your own way of handling losses? Get out. Quickly if I can. My point is that I have a lot of patience and I wait. If I know it is a losing trade, I wait for what I think is the optimum time to bail out. Then I try and reverse. So, if you realize you don't like the trade anymore, you'll get out, but you'll pick your time right. But I will get out. Let's say you are doing that on a day when the market is a one-way street. At what point do you just have to cough it up? It depends how far it has gone against you. If it's against you a long way, at some point you just throw it in. Those days happen maybe 3 or 4 times a year. You just start bailing out. But you usually have a feel for when that is the thing to do, yes, because it has happened before. But normally, if you are just a bit behind in a trade, you are better off if you let the market move a little in your direction and try to sell on strength or buy on weakness, instead of just trying to dump it in a hurry, right? Is that a key element to your trading style? Yes. Never give up on a trade. Many traders who are in a losing trade will just get out because they were taught that you have to have discipline. Great. Those traders will always be around. But if they just had some patience and said, yes, it is going to be a losing trade, but instead of getting out here at 7, maybe if I wait and just sweat it out for another minute, I can sell at 10. Is it a matter of just wanting to get out, to stop the pain, and if they were willing to stand the pain a little longer, they would be better off? Is that a fair way of putting it? Yes. They give up too quickly. In most cases, if you don't give up, you might be able to turn a 5-yard loss into a 2-yard loss. Your trading size has obviously grown quite dramatically since you first got into the business. Has 139 that made it harder to trade? Yes, you have to adapt. You need to change your method of buying and selling because the market is continually changing in subtle ways. What changes have you seen in the bond market since you got in? Well, you can trade bidder size. Now you can usually trade a couple of hundred at each tick. It doesn't move the market as much. How about 1,000 lots? It depends on the liquidity at the time. Lots of times you can get out. It is amazing how much liquidity there is when you want to get out. On average, if you had to dump 1,000, how much would that move the market depending on the time of day and the liquidity? Maybe 1 or 2 ticks. Not much at all, no, not much. Has size been an impediment at all if the liquidity is that good? Yes. It is harder. Generally, when you get into a big position, the rest of the floor knows about it because they stood there and watched you. At least they think they know. They all put their hands down and wait when they think you are wrong. It is natural for a trader to be skeptical. I would almost think that because you have a long-term record of success, they would more often coattail you. Lots of times that is true, and that also makes it harder to get in and out. When you go to offer them, they are all offering too. How do you handle those situations? You have to pick your spot. You have to wait for the big paper order to come in and then go for it. Does it become like a chess game, where you sometimes want the bit thinking that you are selling when you are really buying? Yes, sometimes. But generally, you can't trade big size when you are doing that. So, frequently, if you are long and want to liquidate, you just wait for the bid to come in right. What kinds of things do you look for in a chart? Key points such as the high and low for the week, the halfway back point, and consolidation areas. Do you use charts for short-term or long-term perspective? Short-term. Short-term in your case meaning, I guess, as short as possible. You get in a trade, make money as fast as possible, and minimize your risk. I've noticed that a lot of times bonds will take out 1 and 2 week highs or lows by a few ticks and then pull back. The price action almost seems like a trap for the breakout players. Is that a pattern in the bond market? Yes. It always has been. Do you use fundamentals? Whenever any important fundamental numbers come out, I use them. Do you use the fundamentals indirectly? That is, by seeing how the market responds to the new information? Yes, but also by being the first one to trade off the new fundamental information. I know what I am going to do if a number comes out one way or the other, and I usually have the opportunity to be first. You want to get there before the crowd does. Are you normally right on that type of trade? Yes. You've done tens of thousands of trades. Does any single trade stand out as particularly emotional? The first 100 lot I did. It was a milestone. What kind of jump was that for you? You tend to go from 1 lot to 5 lots to 10 lots to 20 lots to 50 lots. So you probably went from 50 to 100. Do you remember that trade? Yes, it was a much bigger risk. The market was trading at 64.25 and a broker bid 25 for 100 lots. But he didn't put a size on it, he just bid 25. So I said sold. He thought I was being funny and said I'll buy the 100, knowing I had never traded that big before. So I said, well, I'll sell you 100. The market went to 24, offered instantly. It almost sounds like you did your first 100 lot as a dare. Well, almost. But I wasn't a very good trader then. I immediately bought 10, then 10 more. I was trying to bid at 23, and the market went to 22, offered. By the time I got out, I had 10 different people in the trade because I 140 didn't know how to cover 100 lots. But the trade worked out for you? Oh, yes. Well, actually, the word got out that this small trader had done a 100 lot. So I had to go up to the office to talk to the clearing firm after the close. How long had you been trading at that time? 6 months. That was pretty early on. I assume your capitalization was really inadequate to handle 100 lots, right? I had probably made $100,000 by then. Maybe not even that. Even at $100,000, that wouldn't cover you for much of a move. Yes, only 1 point. In bonds, 1 point equals 32 ticks, the smallest price movement. I told them, look, I just thought it was a great trade at the time, and I'll probably never do it again. How long was it before you traded 100 lots again? 2 days. You just never thought about the risk side of it. No, if a guy bids 25 for 100 and I think that it is a great trade, I just say sold. Is there any element in your mindset as a trader that says I had better be careful, that I'm always in the game? That came later. Are you always in control? Or are there days when you have lost control? There were days when I've lost control. Any that stand out? A couple. You have to say that about any day you lose a couple of $1 million. Were those days one-way street markets? Yes, one-way streets. Because I'm a market maker, I take the other side of the trend. So if the market goes one way for 50 ticks, I can guarantee you I'm going the wrong way, and at some point it is going to be a loss. What was your position at the October 1987 low in bonds I was long? When did you start getting long 5 points higher? 5 full points. You mean 81, yes. The day it broke below 771 was long thousands of contracts. Other traders were also heavily long. That was the day we gapped sharply lower. Who was selling the commercials just kept selling. Did you have second thoughts? Yes. Did you think if the market went down to 76, maybe it could go to 70? No. At that point, you had to say it was all over and done. Why technical analysis and experience? Was that an example of your being patient in picking your spot to get out, even when the initial trade was wrong right? Do you ever use any trading systems for anything? No. They wouldn't be there if they weren't wrong. Do you think trading systems are a losing game? Sure. Why do they exist, you tell me? Because people aren't confident in their own ability. If you had a really good trading system, you could make millions. Why would you sell it for $29.95? Does luck have anything to do with trading? Trading is like any other job. You work hard, put in the time and effort, and make your own luck. I was lucky that the first 100 lot I sold was a winner. But why was I lucky? Because I stood there all day for over 6 months, developing and honing market feeling. When the opportunity occurred, I didn't hesitate. You have to pay your dues to get the luck. Right. Are there people on the floor who are not good traders, but are way ahead because they just happened to do a couple of big trades on the right side of the market? Can anybody really get by just on luck? No, not for long. The rule of thumb is if you have lasted a year, you will make it, but it is hard. 141 are there traders that you are influenced by because you respect what they are doing? Oh, yes, they are indicators. So that is actually part of your trading approach. For example, if trader X is a good trader and he is on a roll, and you are thinking of selling and he does, then you know you're right. But if he is buying, then you hesitate. Maybe you don't get into the trade. Are there traders who can't succeed because their ego is too big to ever be influenced? Yes. Is part of the success a willingness to not always do your own thing right? You have to adapt to your success. If you make a lot of money, all of a sudden you start to think you are infallible. You forget the reason you were right was because of all those little factors that you followed. As soon as you think, I'm the guy who is going to lead the way, you get slammed. So it really doesn't make a difference whether it is your idea or somebody else's. Winning or losing is all that counts. Where the idea came from isn't important, right? Do you have to be somewhat of an egomaniac to be a good trader? Actually, the best traders have no ego. To be a great trader, you have to have a big enough ego only in the sense that you have confidence in yourself. You cannot let ego get in the way of a trade. That is a loser. You have to swallow your pride and get out. After you get way ahead, is there a temptation to say, the extra money doesn't mean anything anymore, maybe I should cash in the chips? I never thought that way. Obviously, when I started, I needed to make money to support my family, but I never had a goal to make $1,000,000. I said, hey, this is great, maybe I can make $100,000. You passed that a very long time ago. Do you have any other goals? No. You just do what you do because you enjoy it? Yes. And I hope it lasts. Baldwin's incredible trading achievements made him an ideal interview candidate for this book. However, I did not really expect his comments to be pertinent to myself or other off-the-floor traders. After all, what could a floor trader, whose time horizon is measured in minutes and seconds, say that was relevant to traders who hold positions for weeks or months? To my surprise, the interview yielded some relevant insights. Perhaps the most important point made by Baldwin was his emphasis on not viewing trading in terms of money. To him, money is only a means of keeping score. By contrast, most traders tend to think of gains and losses in terms of their monetary implications, a frame of mind that only gets in the way of making trading decisions. For example, assume you originally planned to risk up to $5,000 on a trade and quickly find yourself down by $2,000. If at this point you start to think of the trade in terms of money, for example, the extra $3,000 can pay for my vacation, you might well liquidate the position even though you still believed in the trade. It is one thing to get out because you no longer like the position, but it is quite another matter to liquidate on impulse simply because you have translated the risk into tangible terms. Another interesting point made by Baldwin is an unconventional one. Don't get out of a losing trade too hastily. Instead, wait and choose your time. This advice seems to fly in the face of most trading advice. After all, isn't one of the basic tenets of trading success to cut your losses quickly? However, I don't think Baldwin's statement contradicts the rule. I believe he is saying that often the worst time to bail out of a position is during a violent price move against you. Baldwin's point is that by bearing the pain just a little longer, you may be able to find a more favorable circumstance for liquidating. Of course, this philosophy should be applied only by disciplined traders, those with the ability to maintain a risk control strategy. 142 Tony Saliba one-lot triumphs. Tony Saliba came to the floor of the Chicago Board Options Exchange in 1978. After a half year of clerking, Saliba was ready to try it on his own. He found another trader to back him for $50,000, and after a favorable start, nearly self-destructed. He pulled back from the brink of disaster by altering his trading techniques and has been successful ever since. Saliba's trading style can be described as trying to do a little better than treading water day in, day out, while being positioned to take advantage of the rare spectacular trading opportunity. His fortune has been built largely by exploiting only a handful of such events. Two of these situations, the Teledyne price explosion and the October 1987 stock market collapse, are discussed in the interview. The impressive aspect of Saliba's trading achievements is not the few spectacular gains he has registered in his career. Rather, it is that these gains have been achieved by using a trading approach exemplified by incredible risk control. In fact, at one point, Saliba managed to string together 70 consecutive months of profits exceeding $100,000. Quite a few traders have become multimillionaires by scoring several big hits. A much smaller number have managed to hold on to their gains. Only the rare trader can boast both occasional dramatic gains and consistent trading profits. Readers unfamiliar with options may wish to first read Appendix 2 in order to understand the trading-related references in this chapter. Although the homework required for Saliba's successful trading is extensive, he has nonetheless managed to diversify into a wide range of other ventures, including real estate investments, a software company, and a restaurant chain. Overall, his extracurricular business endeavors have proven only modestly profitable, but they have indulged his appetite for variety. During the time these interviews were being conducted, Saliba was involved in the most important business venture of his life, negotiating with a French bank to back him with several $100 million to form a major trading company. His goal is to discover and train a generation of successful traders. Saliba is a likable person who makes you feel like you're one of his best friends within 5 minutes of meeting. He is a person who genuinely likes people, and it shows. On the evening before our scheduled meeting, Saliba had a minor accident, slipping on the marble floor at the Health Club in the Chicago Board Options Exchange building. As I showed up at the scheduled time, His aide told me that Tony would not be in that morning due to the accident. I left a message. Saliba called later that day, and to spare me the inconvenience of missing my flight that evening or making another trip to Chicago, he arranged to meet me several hours later. We talked at the La Salle Club bar, which was sufficiently empty to not cause a major distraction. Initially, I was too intensely focused on directing the interview to pay any attention at all to the large movie screen at the front of the bar. Later on, however, as I relaxed, I glanced at the screen as Saliba was answering one of my questions. I instantly recognized the train scene from the movie Risky Business in which the sensuous Rebecca De Mornay seduces Tom Cruise. I have a bad habit of severely overscheduling my appointments, and as Saliba was my third interview of the day, I was beginning to feel the strain. My first thought was, keep your eyes off the screen. You are having a hard enough time keeping your mind focused as it is. My second thought was, it would be incredibly rude not to pay full attention to Tony, especially after he literally hobbled over to spare me the inconvenience of having to reschedule our interview. My third thought was, thank God I'm the one facing the screen. What led you to become a trader? I was a caddy for some grain traders when I was in high school. In college, a friend of mine asked me if I would like to be a broker. I thought that he meant doing the same thing as the guys I had caddied for. So I said yes. Great. Where Indianapolis? He answered. I said, what exchanges in Indianapolis? None. He said, you do it on the phone. I had this impression of hello, New York, buy, Chicago, sell. When I got there, I found out I was a salesman. After a few months, I asked the guys in the office, who makes all the money in this business? They said you have to be on the floor. Right there, I decided to go to the Chicago Board Options Exchange. On the floor, I met one of the traders I had caddied for years ago, and he grub-staked me with $50,000. Isn't that unusual? Giving $50,000 to a kid who used to caddy for you it was, except that he was very wealthy and needed to get off the floor because of his high blood pressure. He owned a seat that he had bought for only $10,000 and just needed the ability to trade in a customer account. I was going to help him do that. What made him think you could make it as a trader? He had heard some rumors around the floor that I was a hotshot clerk, and he basically took a chance on me. What happened? I went from $50,000 to about $75,000 in the first 2 weeks. I had put on all these volatility spreads and option position that will gain if the market becomes more volatile, and they were getting pumped up. Did you think, boy, this is easy? I thought, this is it. I mean, I was a genius. But what I was really doing was taking the opposite side of positions the other brokers were liquidating, letting them out of the market with their profits, while I was left holding the bag. This was spring 1979, and implied volatilities were very high because 1978 was a very volatile year. Well, the market went nowhere and the volatility and option premiums collapsed. Within 6 weeks, I had lost almost everything. The original $50,000 was down to only about $15,000. 1 cent was feeling suicidal. Do you remember the big DC-10 crash at O'Hare in May 1979? When all those people died, that was when I hit bottom. 143, was that a metaphor for your mood? Yes. I would have exchanged places with one of those people in that plane on that day. I felt that bad. I thought, this is it. I've mined my life. Did you feel guilty because you had lost someone else's money? Yes. And I felt like a failure. Had you started out confident initially? I was very confident because before I started trading on my own, I had clerked for a broker for 4 months and picked his brain clean. And now you thought the game was over? Yes. In June 19,791 decided that I better find another job. I went to the Levy brothers, who owned a chain of restaurants that my dad built for them. They said, "Any time you want a job, you can run one of our restaurants." So I said, "Hold that line. I am going to give it one more month. Did you feel better because you had a cushion? Yes." I said, "This is great. I've still got 15 grand in my account." "You had a stop on your life, so to speak." "Exactly, exactly. I had a stop on my career. So I decided to go back and give it one more shot." "Did the fellow who staked you know how much you had lost? Did he ever say anything?" "Oh, good question, Jack. He called me every night. I've grub staked many guys since then, and 3 or 4 of them have lost more than 50 grand each. This man was a multimillionaire, and he acted as if this was the end of the world." "Did he ever ask you for the rest of the money back?" "No, he just moaned and groaned. He had become wealthy through inheritance and money he made in another business. He really didn't know much about option trading. He had bought the seat to have something to do with his life. He told me, 'If you lose $5,000 more, we'll pull the plug.' So I spent the next few weeks winding down my positions. During that time I sought advice from the more experienced brokers on the floor. They said, 'You have to be disciplined and you have to do your homework. If you do those 2 things, you can make money down here. You might not get rich, but you can make $300 a day, and at the end of the year that's $75,000. You have to look at it that way.'" It was like a light bulb went on. I realized that this chipping away approach was what I should be doing, not putting myself at a big risk trying to collect a ton of dough. At the time I was in Teledyne options, which was a very volatile market. So I switched to Boeing, which was a very tight, narrow range type of market. I became a spread scalper trying to make a quarter or an eighth of a point on a trade. I stuck strictly to my goal of trying to average $300 a day, and it was working. This period taught me to be regimented and disciplined. This day I live by the credo of hard work, homework, and discipline. I teach my guys that. Anyway, at this same time I still had the remnants of a big spread position in Teledyne that I was in the process of liquidating. It was a position that would lose in a rising market. One day after I had been trading Boeing for about 5 weeks, Teledyne started moving up sharply. I was not going to let it get me again. I rushed into the Teledyne pit to take my position off. I was hearing floor brokers come in with orders, and all of a sudden I found myself responding to them. I was adapting the same technique I had learned in Boeing to Teledyne, except instead of scalping for an eighth or a quarter, I was scalping for halves and dollars. "What size were you trading at the time?" "I was doing one lot at a time." The guys didn't like me because I was getting in their way. They wanted to do 10 or 20 lot orders. "In other words, you were just a nuisance." "Exactly. How did you get someone to take one lot on the options floor? It's first come, first served. If you have 100 to sell and someone bids first for just one, you have to do his one before you do 99 with the number 2 guy. The broker could ignore you if he wants, but if he does, he's breaking the rules. Were you ignored, the brokers never did, but the market makers on the floor did." "By brokers, you mean order fillers?" "Yes. The floor brokers are the order fillers, and the market makers are the locals who trade for themselves. On the options exchange the two are separate." "Were you the only one lot trader in Teledyne for the most part?" "Yes." "Did you take a lot of ribbing?" "Oh, did I? They called me one lot for the longest time. The individual who gave me the hardest time was the best trader in the crowd. He had made millions and was virtually a legend in his own time. He started leaning on me and ribbing me right from the beginning. He made my life miserable. 144 did your ego get dented by these really successful traders railing you?" "Oh, yes." And it went on for almost a year, day in, day out. Were you tempted to pick up your trading a little bit? I did, but not for that reason. My backer, who had given me such a hard time when I was down, was the prod. Although he didn't know that much about trading, he did give me one piece of very useful advice. Once I started turning it around, he told me to increase my size. He said, "Tony, a banker makes his first loan and he is very careful, but as he gets more comfortable, he makes his loans bigger. You need to increase your size." How did the harassment you were taking on the floor finally end when they introduced puts in June 1980? The lead trader, who had given me the hardest time, hated them. He said they were bad for the business and he didn't want to trade them. I seized that opportunity to really study what puts would mean to us, and I was one of the first market makers to start trading puts. Actually, it opens up a whole range of new strategies. Oh, unbelievable. These other guys were set in their ways, even though they had only been there a couple of years. Sooner than you might think, this NM member one trader befriended me and suggested that we work together. We started working on advanced strategies, getting real creative and abstract. Were you working these out on a computer? No, we did everything by hand, writing out all these what ifs. Didn't you still have to be guessing right on price and volatility direction? You would have to guess right on volatility. However, we didn't have to peg market direction because we were setting up spreads that had a big edge. For example, one option might be highly overvalued because it was popular among the member firms. Eventually, I felt I was doing more of the work while this top trader in the pit was counting on his ability to muscle the market. He would also stray from the strategies we had worked out and even started doing things to try to hurt me. I would say, "What are you doing?" He would just answer, "I changed my mind." Finally, I just said, "Forget it, I'm working on my own." I started taking on more size. When interest rates went through the roof in 1981 and early 1982, my strategies worked really well and I started making a lot of money. Then in the bull market in 19,000, 821 head days when I was making $200,000 a day. The guys in my clearinghouse couldn't believe the sheets. There was just tons of paper. What kind of trades were you doing? I was doing everything. I consider myself a matrix trader. I trade everything on the screen as it interrelates to everything else. My basic strategy, however, was buying butterflies along or short position at one strike price balanced by an opposite position in higher and lower strike options. For example, long 1 IBM 135 call, short 2 IBM 140 calls, and long 1 IBM 145 call and offsetting that with an explosion position. By buying butterflies, do you mean you were long the middle or long the wings, that is, the higher and lower strike price options long the wings? Your risk is limited, and if the market does not move widely, time decay works in your favor. Barring a favorable price move or an increase in volatility, the value of an option erodes steadily over time. In a relatively flat market, the premium erosion in options with a strike price near the market price middle in butterfly spread will be greater than that of options further removed from the strike price of wings in spread. Of course, I tried to buy the butterflies as cheap as I could. If I chained enough of them together, my profit zone would be fairly wide. Then I would do an explosion position in a more distant month. What do you mean by the term explosion position? That's basically my own term. An explosion position is an option position that has limited risk and open-ended potential, which will profit from a large price move or an increase in volatility. For example, a position consisting of long out of the money calls and long out of the money puts would be an explosion position. It sounds like the basic unifying feature of the explosion position is that as the market moves, The delta, the expected price change in the option position given a 1 unit change in the price of the underlying market increases in your favor. So you are really betting on volatility. Exactly. In effect, this is the opposite of what you do with the butterfly. Yes, I put on the butterfly in the front month, where time is working for me, and the explosion position in the mid or back month. Then I complement that with scalping to help pay for the time decay in the explosion position. In other words, the explosion position is your money bet in case of a big move, while your scalping is paying the bills, that is, the time decay cost of the explosion position. Exactly. Were you always offsetting one position with another, in other words? Were you always dealt a neutrafel an option position in which total equity will remain roughly unchanged for small price changes in either direction? Usually, but once in a while I would take a significant net position. What was your first really big trade, Teledyne, in 1984? The stock had dropped sharply and I was building up a position in the out-of-the-money October calls. Well, the stock started inching back up, but these guys from the Pacific Coast Exchange, where they also list Teledyne, were leaning on my longs. They just kept battering them on the close every night. Instead of shying away, I stepped up and would buy them. You want to sell them at, I'm one bid for 50. This went on for over 10 trading days. 145. Why were these Pacific Coast traders leaning on the calls? The stock had gone down from 160 to 138 and then inched its way back up to 150.1. Guess they didn't think it was going to go up anymore. On May 9 at 920, they stopped trading in Teledyne because of news pending. The news comes across the tape. Teledyne announces a stock repurchase program bet $200 per share, buying back their own stock. Yes, the stock was at 150, $5, and I owned the $180 calls. Overnight, I made millions. The stock eventually went up to $300. The next 4 to 5 months were great. What happened after that? One of my goals in life was to become a millionaire before I was 30 and retire. Well, I was a millionaire before I was 25. I had decided to retire when I was 30. On May 5, 1985, my 30th birthday, I walked off the floor and said goodbye to everybody, and that was it. I was never going to come back to the floor. How far were you up then? About $8 minus 9 million. Did you know what you were going to do? I didn't really know. I thought I'd stay in the business somehow, but work off the floor. How long did your retirement last? About 4 months. Were you bored? Yes. I missed the markets. I missed the excitement. So, in the beginning, money was the goal, but once you got there it became, yes, it became secondary. Maybe if I had a wife and kids or someone special in my life, I might not have gone back. But trading was my life. It made me feel like something. It gave me a reason for being. I understand one of your best trading periods was the week of the October 1987 stock crash. Tell me about it. I was expecting a big move, but I didn't know if it would be up or down. So I started building the same type position that I had in Teledyne, the butterfly spread combined with the explosion position. Yes. What was the explosion position in this case? In this case, it was formed by buying out of the money puts and out of the money calls in the back months. To counterbalance this position, I had butterfly spreads in the front month, which would profit from time decay. What told you the market was going to have a big move? You could feel it in the wild gyrations that were occurring by late September. Did you expect the move to be on the downside by that time? Actually, I thought it was going to be on the upside. At first, I thought we were going to attack the old highs again. When did you change your mind? On Wednesday of the week before the crash, the market fell apart. Thursday, it didn't bounce back, but kind of churned. Now, if it had rallied on Friday, then I would have been confused. But instead, the market cracked on Friday. At that point I was sure we were going down. Because it was the end of the week, yes, and there is a high correlation between the action on a Friday and the follow-through on the next Monday, at least on the opening. Did you have any inkling of the size of the impending move on the following Monday? Do you know what I really thought was going to happen Monday? I thought the market would open lower, go down sharply, and then bounce back to about unchanged. I actually bought out of the money calls that Friday for protection. But you said you thought the market was going down, yes. But I just wanted to have some insurance. A trader once told me, Saliba, in stealing second, you never take your hand off first until your other hand is on second. That's the way I am. I always have insurance. Still, you must have been awfully confident that the market was going sharply lower on Monday morning. According to the cover story in Success Magazine, April 1988, it sounds like you knew the market would collapse. It says you even deliberately chose to go to the office instead of the floor to avoid being influenced out of your position by all the confusion on the floor. Isn't that highly unusual for you to go to the office instead of the floor on a trading day? Yes, if I'm trading, I'm on the floor. But that article is completely misleading. They wrote it that way to sell magazines. They make it sound like I planned and plotted to avoid the floor that day. That's not the story. I was concerned about the positions held by my clearing firm. One guy in particular had a huge position which he wasn't closing, and I had to spend a great deal of time on the phone. Now, that's not as dramatic as the way the magazine wrote it up, but that's what really happened. 146. Didn't you also sell your seat? That day you must have been really confident the market was going down to sell a seat. I hit that seat before the market opened. I figured if I didn't hit the bid for the seat, someone else would. Anyway, I had 7 seats. I just sold one. Was this the first time you traded a seat? I mean, seats aren't exactly a liquid market. Yes, it was the first time I did it like that, trading the seat round turn in one day. But I have traded seats before. I trade them depending on my mood in the market. On balance, though, I want to be long seats. I believe in our industry. But in that circumstance, it did seem like a good trade. I figured, hey, I have a lot of exposure in seats, a few $1 million worth. I'd better take some protection. I sold that seat for $452,000 in the morning and bought it back the next afternoon for $275,000. How much did you make that Monday that has caused me a lot of headaches? I would rather not say. Obviously, your big money was made in the out-of-the-money puts. What percentage of that position did you keep as of Monday's close? About 95%. You kept most of it, but the profits were so huge. Wasn't it tempting to just take it? The reason I didn't cover was because I felt my long puts hadn't gone up enough. They all went to parity. The puts that were 30 points in the money were trading at $30. In other words, the option premiums consisted almost entirely of intrinsic value. The market wasn't giving them any time value premium. Given the enormous market volatility, I thought that was crazy. So you figured you would wait till the next day. Yes, and do you know what I did to hedge myself? I bought more insurance at the close on Monday. I covered hundreds of my short calls. You were basically buying more volatility. It was the best thing I could have done. The next day, they didn't know what they wanted. More of half the world wanted puts, and half the world wanted calls. But everybody wanted volatility. That's when the register really started ringing. It was the day that the sun was so close to the earth that everybody needed zinc ointment, and I was the only guy that had some left. Let's take the other side of the fence. What did the traders who got buried in October do wrong? They took for granted that Monday would be a normal day. They started out long, thinking the market was just correcting and was due for a bounce. Then they bought on the way down, they bought every dip. Did some traders just freeze? Sure, some did. I have one friend who is $1 million annual earner. On Tuesday morning I walk in and say, "Hey Jack, what do you think? Are you going to get them today?" But he just stood there. He didn't say a word to me. He looked shell-shocked. He just kept going over his sheets, looking for something to do, but not knowing what to do. So he missed all the opportunity. Why was the way you responded to the market so different from the way your friend responded? He wasn't sure what his position risk was. I always define my risk, and I don't have to worry about it. I walk into the pit every day with a clean slate, so that I can take advantage of what is going on. A clean slate sounds like you come in with a flat position every day, but you obviously hold positions overnight. I mean that I'm always hedged and I'm always prepared. Do you always know the maximum risk in a position that you hold? Do you always know what your worst case is? Yes. Now, what could happen? The market sits, it explodes, or something in between. But no matter what happens, I know my worst case. My loss is always limited. Why do so many traders who come to the floor end up losing everything? I think the biggest problem with some traders that come on the floor is that they think they're bigger than the market. They don't fear the marketplace, and they lose sight of their discipline and the hard work ethic. Those are the traders who get blown out. But most guys on the floor really work hard. What is the biggest misconception the public has about the marketplace? The idea that the market has to go up for them to make money. You can make money in any kind of market if you use the right strategies. With futures, options, and the underlying markets, there are enough tools available to set up a game plan for any situation. In other words, the public has too much of a bullish bias. Yes, it is the American way the market has to go up. The government never said anything about program trading when we were in a 3-year bull market. Once the market started going down, all of a sudden program trading became a major concern, and they set up commissions galore. For the average person, like my mom or dad and their relatives, the biggest misconception is that they think 147 when the market goes up, you make money, and when it goes down, you lose. People need to approach it from a more neutral standpoint and say, I'm going to be a little long in this category and short in this category, but limit my short side risk because it is infinite. How do you handle a losing period? How do you lose money? It is either bad day trading or a losing position. If it's a bad position that is the problem, then you should just get out of it. Is that what you do? Yes. I either liquidate it or neutralize it, because then you are back afloat. When you are in a boat that springs a leak, you don't drill another hole to let the water out. What if your trading losses are due to your making bad decisions? What do you do then? Take a day off. If I get myself all wound up, I like to lay out in the sun and bake for a while and let all the strenuous stuff go out of my head. What are the elements of good trading? Clear thinking, ability to stay focused, and extreme discipline. Discipline is number one. Take a theory and stick with it. But you also have to be open-minded enough to switch tracks if you feel that your theory has been proven wrong. You have to be able to say, my method worked for this type of market, but we are not in that type of market anymore. Trading rules you live by. I scale in and scale out of my positions so that I can spread out my risk. I don't like to do all the large order right up front. What else? Always respect the marketplace. Never take anything for granted. Do your homework. Recap the day. Figure out what you did right and what you did wrong. That is one part of the homework. The other part is projective. What do I want to happen tomorrow? What happens if the opposite occurs? What happens if nothing happens? Think through all the what-ifs. Anticipate and plan rather than react. When you made your first few million, did you sock some of it away to limit your worst case possibility? No. My trading strategies were growing and I needed new capital. Then after I made some more, I started putting money into other investments, real estate, stores, exchange seats, and things like that. Then when the market crashed, I hate to use that term, on Monday, October 190, one realized that I didn't have a big chunk of cash anywhere, so I took a couple of $1 million out of the flow and bought T-bills. Then, a few weeks later, I used the money to buy an annuity. I guess because your trading style is so focused on limiting losses, the first time you felt the need for a safety net was when the market seemed to be saying that a catastrophe could occur and have nothing to do with you. Yes. What happens if you have $10 million in your trading account, but they shut down the game? How do you set goals? Until recently, I set goals on a monetary level. First, I wanted to become a millionaire before I was 30. I did it before I was 25. Then I decided I wanted to make so much a year, and I did that. Originally, the goals were all numbers, but the numbers aren't so important anymore. Now I want to do some things that are not only profitable, but will also be fun. For example, I'm currently working on setting up a trading company and a software company. I also want to do the family type thing. How do you judge success? I used to judge success as being the best in your field, like Bruce Springsteen in rock music. In my industry, it would have to be dollar-wise. Now, I think it is more quality of life. A lot of people think I am a success, but I don't feel like I'm a success. I really don't. I feel like I've made a lot of money, and I've been successful at this one area in my life. I help the needy, but I don't have that family fulfillment. How do you judge success? I don't know. All I know is that all the money in the world isn't the answer. You thought it was at one time. Yes, I did. And to be honest, money is important because it is influential. See, that guy standing over there, I don't know him from Adam. But say he came over to talk to us. If he made a really bad first impression on me, I might not have much respect for him. But if you then told me that guy is worth $50 million and he made it on his own, that would completely change my opinion of him. That may not be fair, but that's the way it is. How does trading affect your personal life? I'm able to handle it well from a business standpoint, but from a social standpoint it clobbers me. It doesn't allow me to give the time to women and friends that they require. People like to just sit and talk sometimes. Unless it is about business, like this with you, I'm out of here. Are you always that conscious of time? Yes. Most people aren't. They say, well, don't you ever just sit home and watch TV, do you? Well, I might have the TV on, but my head is always on trading. Last night I came back from a dinner date at midnight. I was tired and wanted to go to bed, but I was up until 200 a.m. figuring out trades. It's an addiction. I 148 used to be much worse. I got lots of grief from former girlfriends because I would take my work with me on dates. I don't do that anymore, but I'm always still thinking about trading. What makes you different? I think I can do anything, and I'm not afraid of hard work. Right now, for example, I'm working on a deal with a French bank to put together a trading company. I can't wait until this venture starts up so that I can start working with these kids, training them to be traders. I don't know exactly how much the bank is going to give me, but I could have hundreds of millions to work with. I love that type of challenge. It is important to realize that many of the great traders interviewed in this book were not immediately successful. Saliba's initial trading experience was so disastrous that it brought him to a near suicidal state of mind. However, what these traders share is a sense of self-confidence and persistence. In the case of early failure, these traits are enough to lead to eventual success. the size allowing him to make a comeback from his early poor start. Saliba's persistence also came into play at other points in his trading career. For example, many others faced with the type of constant ridicule that Saliba was subjected to in the Teledyne pit might have abandoned their strategy. This same Teledyne example also illustrates another important characteristic of the superior trader, the maintenance of rigid risk control, even in difficult circumstances. It must have been very tempting for Saliba to trade a larger position size in the Teledyne pit when he was being derided as one lot. Instead, he maintained his discipline and continued to trade small until his capital had grown sufficiently to allow him to increase his position size. Working hard and examining many different scenarios so that he is prepared for all contingencies is a critical element of Saliba's success. By anticipating all the what-ifs, he can take advantage of situations such as the October 19 stock slide instead of being immobilized by such events. For many people, the concept of a great trader conjures up an image of someone using a shoot-from-the-hip approach, moving in and out of markets with great agility and a near sixth sense. The reality is far less glamorous. In the majority of cases, exceptional traders owe their success to hard work and preparation. In fact, similar to Tony Saliba, many of the very successful traders will do their homework every night, not allowing leisure or other business from interfering with their daily regimen of market analysis. When they stray from that discipline, it usually ends up costing them money. In Saliba's own words, referring to a recently missed trade due to his failure to have his orders in while on a business trip, "It cost me 10 grand, and all those little 10 grands can add up." 149 Part V, The Psychology of Trading. 150 Dr. Van K. Tharp, The Psychology of Trading. Dr. Van K. Tharp is a research psychologist who received his Ph.D. from the University of Oklahoma Health Sciences Center in 1975. He has spent his career studying how stress affects human performance. His strongest interest is in the psychology of winning, especially as winning applies to the markets. In 1982, Dr. Tharp developed his investment psychology inventory, a test that measures winning and losing traits. Thousands of investors and speculators, myself included, have taken this test, which includes a written evaluation and a 10-minute phone consultation. Dr. Tharp has written 5 books on successful investing, which provide the core of his investment course. He is a contributing editor for technical analysis of stocks and commodities, and has also written numerous articles for other financial publications. Dr. Tharp is a frequent guest on financial television and radio programs, and has spoken at many investment conferences. Dr. Tharp currently devotes himself full-time to counseling traders from his office in Glendale, California, and continuing his research on trading success. A recent focus of this research has been interviewing and studying top traders so that he could create a model for success. His basic theory is that by teaching the winning traits of the top traders, not specific trading methodologies, he can dramatically improve the performance of less successful traders and investors. In his most recent project, he is attempting to turn his most successful clients into super traders by extending his normal program of 2 two-day sessions into an ongoing semi-annual process. After I interviewed Dr. Tharp, he asked whether he could do a videotape interview of me as part of his ongoing research. Since I thought such an interview might be helpful in improving my own trading performance, I eagerly agreed. The interview lasted for over 4 hours. Dr. Tharp has a particularly probing questioning style. After an initial response to a question, he would ask, "What else?" and repeat this process several times. When I could no longer think of any additional responses, he would have me shift the direction of my gaze. He later explained this instruction was intended to facilitate accessing different parts of my brain, and sure enough I would think of another point I had somehow overlooked. I felt that this interview yielded some important personal insights. One of these self-realizations is briefly discussed in the next chapter. I would have liked to provide my personal impression of Dr. Tharp's basic course, which includes 5 books and 4 tapes. However, although I reviewed the material briefly as background for this chapter, the combination of simultaneously working at a full-time job and writing this book did not leave me with enough time or energy to give the course the serious attention it calls for a personal project I plan for later. I can, however, attest to the fact that one of the traders interviewed in this book served as a subject in Dr. Tharp's project on modeling success, and was duly impressed with his intellect and insight into successful trading. How did you first get interested in the connection between psychology and trading? My primary research interest after graduate school was how various drugs affect human performance. After receiving my Ph.D. in psychology, I spent about 8 years doing fairly standard psychological research. For example, I helped standardize the current field sobriety test battery that police throughout the country are still using. While I was doing that, I also learned how to lose money trading options. In fact, I lost money so fast and so consistently that when I finally got out of the market, I had to conclude that the losses had something to do with me. During that same time period, I enrolled in a class in prosperity at the local Church of Religious Science. One of the principles taught in that class is that what happens to you reflects your mindset. I had read a lot on the psychology of trading, and while I considered most of that information to be folklore, I wanted to test it out. I decided to do so by developing my investment psychology inventory, a test to measure investment strengths and weaknesses as a creative project for that class. No one in the class would take it, so I sent it to R.E. McMaster, the editor of a newsletter to which I was subscribing. McMaster took it and then offered it to his subscribers. Overall, I received close to 1,000 responses, and that really roused my interest in this area as a career. What did you learn in analyzing the responses to your test? Were there any major surprises? I had several measures of success built into the test, so I could rank the responses according to success level. The investment literature suggested 10 different areas that might be important. As a result, I designed questions to measure each of those areas. I did a number of statistical analyses of the data and found a significant correlation between each area and investment success. In addition, I found that those 10 areas could be grouped into 3 major clusters, which I labeled the psychological factor, the management and discipline factor, and the decision-making factor. Although I've since refined the test, I still use the same 3 major clusters. In addition, I still keep the 10 original areas, and I've added an extra 1 intuition. What are the 11 areas you measure well? The psychological factor has 5 areas. These include a well-rounded personal life, a positive attitude, the motivation to make money, lack of conflict, and responsibility for results. Motivation to make money is not significantly correlated with success, but I keep it in the test because lack of such motivation plus high conflict is very significant. There are 3 factors in the decision-making area. These include a solid knowledge of technical factors in the market, an aptitude for making sound decisions without common biases, and the ability to think independently. Incidentally, knowledge of technical factors has little relationship to success based on the test scores. Also, there are 3 management discipline factors. One needs risk control and the ability to be patient. High addition, I also include intuition in this category. Although I have not found any relationship between intuition and trading success, I keep the factor in the test because it is interesting to me. Given those areas, What are the characteristics of the losing trader? The composite profile of a losing trader would be someone who is highly stressed and has little protection from stress, has a negative outlook on life and expects the worst, has a lot of conflict in his or her personality, and blames others when things go wrong. Such a person would not have a set of rails to guide their behavior and would be more likely to be a crowd follower. High addition, losing traders tend to be disorganized and impatient. They want 151 action now. Most losing traders are not as bad as the composite profile would suggest. They just have part of the losing profile. You now consult with many traders. How did you get started in that? After I started using the test regularly, people began to ask me what to do about their particular problems. Since investment psychology is a rather unique area of study, I found I didn't know how to respond to many of their questions. As a result, I decided to write a pamphlet on each of the 10 areas, both to learn about the areas myself and to provide investors with a source of help. The first pamphlet turned into a book. I decided at that point to cover the subject matter in 5 workbooks, which would constitute a course in the psychology of investing trading. After I finished the second workbook, I started training in neuro-linguistic programming (NLP). NLP is really a science of how to duplicate success, and I was able to incorporate a number of those techniques into my course. The development of the course naturally led to a private consulting service. Have your ideas and concepts changed from what they were early in your research? I designed the test to predict who could win and who couldn't. Now, I believe that anyone can win if they are committed to do so. Primarily, it's just a matter of learning how. Too many people get stuck by the beliefs they hold, yet they continue to cling to those old beliefs. My beliefs, in contrast, are constantly evolving, and I think it's because I value them according to their utility. Thus, I'm willing to admit most of my beliefs are probably wrong. For example, there may be people who could not be successful in trading even if they were committed to doing so. But right now, it's most useful for me to believe that anyone can win. When I hold that belief, I am much more effective at helping people become winners. Could you provide some specific case examples of people who succeeded or failed in consultation? One trader who came to me hadn't been able to trade for over a year. He wanted me to get him trading before he did the full consultation. As a result, I had him drop by one morning for about 45 minutes. I gathered some information and made an educated guess that he had a conflict problem. He then went through an exercise that took about 10 minutes. It took him 2 weeks to mentally integrate the results of that exercise, but after that he was trading again. He'd spent a lot of money and done a lot of things to correct the problem, and none of it had worked. Yet it only took a 10-minute exercise and 2 weeks of integrating the results to solve his problem. I tried that with another person who was unable to afford my consulting fee, for whom a simple exercise of that nature didn't work. His problem had nothing to do with his investing. Although he was in his late 40s, he was still a little boy in that he couldn't accept adult responsibilities. He still lived with his mother, and his whole lifestyle supported being a child. The only reason he wanted to trade was to be able to continue that lifestyle. I doubt that I could have helped him without a major commitment on his part to change his lifestyle, which he was unwilling to give. Another client made minor adjustments after 2 days of consulting. He was reluctant to do the follow-up because he thought it would probably be superfluous. But he eventually decided to do it. I spent another 2 days listening to him talk, and then we did a simple exercise together. At the end of that exercise, he was a totally changed person, although it probably took him a week to integrate the effects of that exercise. He called me 2 months later and said he had made over $650,000 trading in the markets. In the case of a trader who uses a non-quantifiable approach, for example, I buy or sell whenever I get a feeling about the market's impending direction from the chart patterns. How do you distinguish whether trading problems are related to lack of skill or to psychological impediments to success before I take someone on as a client? I need to know that they have some sort of methodology that they think works. I determine what evidence they have of that. Can they, for example, convince me have they tested that methodology? Does their testing amount to a hindsight evaluation, or is it based on actual trading signals that one can follow? I also am convinced that it is difficult to make money day trading or trading in a short time frame, so I am skeptical about anyone who wants me to help them day trade successfully. At the same time, I think that lack of skill is, in itself, a psychological impediment to trading. People don't develop a systematic approach or don't test their approach because of poor judgment, lack of goals, internal conflict, etc. So, perhaps the area they need help in is overcoming internal resistance to developing a systematic approach to the market. If somebody came to me and said that was the problem they wanted help with, I would have no problem at all accepting that person as a client. What are the primary psychological impediments that keep most people from being winning traders? How can they deal with each of those problems? What typically happens is that when people approach the markets, they bring their personal problems with them. The markets are a natural place to act out those problems, but not to solve them. Most people end up leaving the markets, but a few decide that they need a system to trade more effectively. Those people who do adopt a systems approach usually just end up transferring their problems from dealing with the market to dealing with their system of trading. One of the basic problems that most traders face is dealing with risk. For example, two primary rails to successful speculative trading are cut your losses short and let your profits run. Most people cannot deal with those two rails. For example, if making money is important to you as it is to most people who play investment games, then you will probably have trouble taking small losses. As a result, small losses turn into moderate losses, which are even harder to take. Finally, the moderate losses turn into big losses, which you are forced to take all because it was so hard to take a small loss. Similarly, when people have a profit, they want to take it right away. They think, I'd better take this now before it gets away. The bigger the profit becomes, the harder it is to resist the temptation to take it now. The simple truth is that most people are risk-aversive. In the realm of profits, they prefer a sure, smaller gain to a wise gamble for a larger gain, and risk-seeking. In the realm of losses, they prefer an unwise gamble to a sure loss. As a result, most people tend to do the opposite of what is required for success. They cut their profits short 152 and let their losses run. If you think of trading as a game and that a mistake is not following the rails of the game, then it becomes much easier to follow these two rails. You should review your rails at the beginning of the day and review your trading at the end of the day. If you followed your rails, even if you lost money, pat yourself on the back. If you didn't follow your rails, then mentally rehearse what you did and give yourself more appropriate choices in the future. The second major problem people have is dealing with stress. Stress really takes two forms: worry and the biological fight-flight response. Our brains have a limited capacity for processing information. If your mind is preoccupied with worry, that worry takes up most of the decision space, and you don't have enough capacity left to perform effectively. One aspect of the fight-flight response is that it causes people to narrow their focus. They revert to earlier well-practiced response patterns. For example, a common decision that people make under stress is not to decide. They do what they did when they were a beginner. They do what their broker advises. In short, they do anything simple. Simple solutions are rarely correct. When people are stressed, they also tend to be crowd followers. The behavior of others provides a simple example to follow. Crowd followers don't have to make decisions, but crowd following is a sure way to lose money in the markets. A second important effect of the fight-flight response is that it causes people to expend more energy. When faced with stressful events, people give more effort to the few alternatives they do consider. They keep on doing what they were doing, only they do it harder. Putting more energy into trading decisions does not help you make more money. Instead, you will tend to make quick, irrational choices which use up some of that excess energy. You probably put more energy into a losing position by actively resisting closing it out. The result is a bitter loss. In summary, the fight-flight response will decrease your performance by causing you to narrow your choices and concentrate more energy on the remaining alternatives. The solution for dealing with stress is to work on the causes and to develop stress protectors. I would recommend that people with this problem go into a stress management program. Also, it is important to understand that many stressful events are such because of the way you perceive them. Change those perceptions and you will change the event itself. For example, winners typically differ from losers in their attitude about losses. Most people become anxious about losses, yet successful speculators have learned that an essential ingredient to winning is to make it okay to lose. Since most people in our culture are taught that only winning is acceptable, most investors must change their beliefs about losses to become successful. The third major problem that people have is dealing with conflict. People have different parts of themselves, each of which has a positive intention. For example, someone might have a part to make money, a part to protect him from failure, a part to make him feel good about himself, a part which looks after the welfare of the family, etc. Now, once you establish these parts, you usually allow them to operate subconsciously. What happens is the parts continually adopt new behaviors to carry out their intentions. Sometimes those new behaviors can produce major conflicts. This model of conflict is one of my most useful beliefs. I am not saying that people actually have parts, but it is very useful in helping people solve their trading problems for me to believe that. You just have to make them aware of their parts and then conduct a formal negotiation between the parts so that each part is satisfied. If possible, you also want to integrate the parts so that they join together. I find the concept of people having different parts in conflict with each other a little difficult to conceptualize. Could you provide an example? I worked with a floor trader whose father was fairly successful. His father was not a good model for him, however, in that he was an alcoholic. As a result, he developed a part to protect himself from being like his father. He could make about $75,000 per year trading, but if he made any more than that, this part kicked in to make sure that he would not become too successful. He was the one who made $650,000 in about 2 months after we had completed the parts negotiation. Are you implying that some people actually want to lose on a subconscious level because it fulfills some other positive intention? How common is that half the traders I work with have problems of this nature? I think it's very common. So far, you've cited poor risk attitudes, stress, and conflict as impediments to trading success. Are there any other major problems people have with the markets? A fourth major problem is that many people allow their emotions to control their trading. In fact, most trading problems appear to involve emotional control in some manner. I know of at least 10 methods of helping people control their mental states. An easy method that people can adopt right away is simply to control posture, breathing, and muscle tension. If you change those factors, you will probably find that you change your emotional state. Finally, the last major problem is making decisions. Although there are many facets to decision-making problems, what most people do is bring their normal method of making decisions to trading the markets. For example, think about what you go through in order to buy a new car. You have to think about the model, make, deal, service, cost, accessories, etc., and it probably takes you a week or more to evaluate those factors and make a decision. Most people bring that same method of making decisions to trading, and it just doesn't work. It takes too much time. So, the solution is to adopt a trading system that gives you signals to act. But most people with a trading system continue to apply their normal method of making decisions to the signals given to them by their trading system. And, of course, that doesn't work. The best method that I've found of dealing with long, ineffective decision-making problems is to short-circuit them through a process called anchoring. That process is a little too involved to explain here. Do you believe that most people can be successful traders if they learn to eliminate negative emotions well? That assumes that negative emotions are the cause of trading problems. I think they are just a symptom of the basic problem. In most cases, I don't believe it's even necessary to solve specific problems to produce Success 153. You simply have to teach people to do things in an effective manner. The teaching process, however, involves working with how people think, and most trainers do not emphasize that. Right now, I consider myself to be an expert modeler. By that, I mean that if someone can do something well, then I can figure out how they do it and teach those skills to anyone else. I am concentrating on modeling trading and investment excellence. So naturally, I believe that I can teach anyone who is committed to being a successful trader to be one of the best. Are superior traders better because of keener analytical skills or because they have better emotional control? Better emotional control. But I think that both of those factors are overemphasized. So what does it take to duplicate successful trading? There are three primary factors involved in duplicating success: beliefs, mental states, and mental strategies. If you duplicate the way the best traders use those three factors for every aspect of the trading task, then you can duplicate their results. As an on-trading example, most martial arts experts believe that it takes years of practice to break a board with your bare hand. I was able to observe someone for about 15 minutes and then break 2K-inch pine boards with my hand. I even showed my son, who was 10 at the time, how to do it. That's the power behind modeling. What happens with most experts is that they are unconsciously competent. They do things well, which means they do them automatically. For example, most people are unconsciously competent at driving a car. You don't even think about it when you do it. When someone who is unconsciously competent tries to explain what he or she is doing to someone else, much of what is important is left out. Thus, my focus is to discover the missing pieces and help people install those pieces. Let's talk about the first factor: beliefs. How are beliefs important to trading success? Let me give you an example from another modeling project. The Army modeled the rifle skills of the two best sharpshooters in the U.S. They were then able to develop a training class for Army recruits in which they reduced the training time from 4 to 2 days while increasing the qualification rate from 80 to 100%. In addition, they were able to use the same knowledge to help the top shooters improve their skills. The information they gathered about shooting beliefs was particularly revealing. The two top shooters, for example, believed shooting well is important for my survival. Hunting is fun. Mental rehearsal is important to successful performance. If I miss a shot, it has something to do with my performance. One of the two top shooters, when they were in competition together, always won, and you could tell the difference between the two in accordance with their beliefs. For example, the best shooter believed that it was important to rehearse an entire 1,000-round match the prior evening, whereas the second best shooter only believed that mental rehearsal was important. In addition, the best shooter believed that it was important to hit the center of the bull's eye on each shot even though you didn't get extra points for that, whereas the second best shooter believed that it was only important to hit the bull's eye. Can you understand why one was better than the other just from their beliefs? Now, contrast the beliefs of top shooters with the beliefs of new recruits coming into the army. The latter might believe guns are evil. They kill people. If they shoot this weapon too many times, they might go deaf. If they miss the target, it means the gun is misaligned. I think, just on beliefs alone, you can begin to understand why the top shooters were so much better than the raw recruits. Now, let me explain some of my findings in working with top traders. You might find some of these beliefs confirmed in other interviews in your book. Generally, I find that top traders believe money is not important. It is okay to lose in the markets. Trading is a game. Mental rehearsal is important for success. They've won the game before they start. Although there are a lot more than 5 critical beliefs, I think these 5 are among the most important. Most people approach trading to make a lot of money, and that is one of the primary reasons they lose. Because money is so important, they have trouble taking losses and letting profits run. In contrast, when you think of trading as a game and play by certain rules, then it becomes much easier to follow those 2 golden rails. In addition, because of mental rehearsal and extensive planning, top traders have already gone through all the trial and error in their mind before they begin. As a result, they know they are going to win in the long run, and that makes the little setbacks much easier to deal with. You mentioned that winners know they've won the game before they start. Although I can easily see how such confidence would be beneficial for the established winning trader, might the impact of this trait actually be reversed for the novice trader, for example, in your first week on skis? Confidence about your ability to go down the expert slope might not be such a great quality. How does the less expert trader distinguish between justified and misplaced confidence? The top traders that I've worked with began their careers with an extensive study of the markets. They developed and refined models of how to trade. They mentally rehearsed what they wanted to do extensively until they had the belief that they would win. At this point, they had both the confidence and the commitment necessary to 154 produce success. In addition, they also had the entire constellation of beliefs I just described. As a result, I believe that there are 3 major differences between justified confidence and misplaced confidence. First of all, justified confidence comes from a constellation of beliefs, such as the one I just described. If a trader has confidence and nothing else, he is probably in a lot of trouble. Second, justified confidence comes from extensive testing of some sort of model of trading. If you don't have a model that you have properly tested, then your confidence is probably misplaced. Third, justified confidence comes with an extensive commitment to being successful as a trader. Most people who want to be traders are not committed, they just think they are. There is a poem by W.N. Murray of the Scottish Himalayan expedition that says that the moment that one definitely commits oneself, then Providence moves too. If you are really committed, then not only are you certain that you are doing the right thing, but somehow events just seem to occur to help you. If you are really committed to being a trader, then you probably have an understanding at some level of what I'm talking about. You probably even understand that those events that help you might be big losses. If you are not committed, on the other hand, then you are probably saying, I don't understand what Tharp is saying. I'm committed, but events certainly have not been helping me. Earlier, you mentioned mental states as the second critical factor in modeling success. Could you explain what you mean by that? If you ask people to list their trading or investment problems, they are of 2 types of problems they don't own and mental state controlled problems. Problems they don't own consist of blaming the markets, blaming floor traders or locals, blaming insider trading, blaming their broker, or blaming their system for what goes wrong. We have a natural tendency to blame something other than ourselves for what happens. Society promotes it. For example, the recent media coverage of program Trading Virtually implies that investors who lost money in the stock market did so because of this activity rather than because of any fault of their own. Yet, when you blame something other than yourself, you can continue to repeat the mistake because it was the result of something beyond your control. The best thing an investor can do when things go wrong is to determine how he or she produced those results. Now, I don't mean that you should blame yourself for your mistakes either. I mean that at some point in time, for any situation, you made a choice that produced those results. Determine what that choice point was and give yourself other options to take when you encounter a similar choice point in the future. Change the decision at similar choice points in the future, and you will change the results you get. And by imagining doing so now, you can make it easy to select those alternatives in the future. When people own their own problems, they discover that their results usually stem from some sort of mental state. Common examples are I'm too impatient with the markets. I get angry at the markets. I'm afraid at the wrong time. I'm too optimistic about what will happen. These are just a few examples of mental state problems. Once you identify a mental state problem, you can do something about it because this sort of problem is within your control. I've already mentioned how one can use body posture, breathing, and muscle control to manipulate one's mental state. To try this out for yourself, go into a shopping mall and notice how other people walk. Duplicate a dozen or so walks for yourself and notice how your mental state changes with each one. I am not saying that controlling your mental state is the magic solution to trading success. It's just part of the answer. But when you admit that the answer is within yourself, you've come a long way. The realization that you are responsible for the results you get is the key to successful investing. Winners know they are responsible for their results. Losers think they are not. Can you give a practical example of how someone can control their mental state well? Mental state manipulation is what most people call discipline. I teach people a very simple procedure that they can use right away. For example, suppose you are at your desk and you become aware that you are in a mental state that you would like to change. Get up out of the chair. Walk away about 4 feet and then look at how you looked in that chair. Notice your posture, your breathing, your facial expressions. Then imagine how you would look if you had the sort of mental state you would like. When you can see that clearly, sit down in the chair again and assume the position that you just imagined. That exercise works for almost any situation as it involves several important principles changing your body posture, seeing yourself from a more objective viewpoint, and imagining a more resourceful state. Please elaborate on mental strategies, the third element you cited earlier as critical to duplicating success. Could you provide some examples to understand strategies? You have to understand how people think. People think in the same modalities as their 5 senses, that is, in terms of visual images, sounds, feelings, and for some people, tastes and smells. Those 5 modalities are to mental strategies as the alphabet is to a great novel, or as musical notes are to a great symphony. It's not the elements, but the way in which the elements are put together. A mental strategy is really the sequence in which you think. Rather than explain a complex topic in detail, which I think is beyond the scope of this interview, let me give you 2 examples. First, imagine that you have a trading system that gives you specific signals. Since most signals are visual, such as a particular chart pattern or certain signals on your computer, imagine that your system gives you visual signals. Now, Try on the following strategy. See the signal. Recognize that it is familiar. Tell yourself what might go wrong if you take it. Feel bad about it. 155. Could you trade effectively using that strategy? Would you even take the signal? Probably not. What if you used the following strategy? See the signal. Recognize that it is familiar. Feel good about it. Could you trade from that signal? Probably. So even though the two strategies are quite similar, they lead to very different results in terms of trading. If you are trading a system, you need a simple strategy like the last one in order to use it effectively. Two of the top traders that you used in your research and modeling success have completely different trading styles. One is very mechanical, while the other uses a much more intuitive approach. Could you contrast their differences and compare their similarities? First, let me talk about their similarities because they are extensive. In fact, when you find extensive similarities between two excellent traders who seem so different, then you can begin to assume that those similarities are essential to successful trading. Both traders, for example, developed models for how the markets work and did extensive research to test those models. Although their ideas are very different, I think the process of developing and testing some sort of model is probably very important. In addition, both traders share all the same beliefs that I mentioned earlier as common to successful traders. Third, both traders are very aware of their purpose in life and as a trader. They believe they are part of a bigger picture and they just go with the flow. The mechanical trader is very logical. He constructs his models visually in his imagination. He is very precise in his language and thinking. His models tend to focus on his concept of how to trade successfully and of how the economy works. He does not believe that his models are adequate until they can be converted into algorithms for the computer that match his own mental processes. As a result of this belief, he has computerized his models, modifying both his constructed image and his computer output until both models match in his words, until they both look right. This is a very slow and laborious process. I think it hinders his decision-making on everyday events, and he tends to agree with me, but it helps him in the long run. When his mental image and the computer model match, he virtually takes himself out of the trading picture. The computer does everything, so at that point, decision-making is easy for him. The intuitive trader, in contrast, has developed a model of how he thinks markets operate, rather than a model of how to trade successfully. He also believes that the markets are constantly evolving and that it is more important to keep up with changes in the market than to test his models by developing an algorithm to computerize them. He trades from his expectations of what the markets will do, which are visualizations. But I think that he tends to convert his visualizations into feelings. Feelings actually are a mode of thinking, but they are difficult to communicate to others or to computerize. As a result, he believes that exercises such as computerizing a trading system are a waste of time. Remember that his main emphasis is to explain how markets work rather than how to trade, and he believes that the markets are constantly evolving. As a result, he has difficulty explaining how he trades to anyone else. He just calls it intuitive. At the same time, he makes day-to-day decisions easily, a distinct contrast to the mechanical trader who is uncomfortable until he has proven his work by computerizing it. What are the most difficult problems to solve? I think there are only two difficult problems. One is lack of commitment to trading. People are not going to do what I tell them to do unless they are committed to becoming a good trader, so I don't see many non-committed traders. It's only occasionally, when I do a free or reduced rate consultation, that I see traders with this sort of problem. The man who wanted to remain a little boy and was trying to use trading as a means of accomplishing that was a classic example. I don't make the mistake of seeing non-committed traders too often. The second most difficult situation is the trader who does not own his problems. This person can continue to repeat his problems because he never gets at the source. Once again, I usually don't see these people. When people come to me, they realize that they produce their own problems, although, to some extent, everyone has problems that they don't own, even my clients. Among the people who come to see me, I think the most difficult type is the compulsive gambler. Since these people typically crave the action of the markets, they are not likely to want my help until they are heavily into debt. At that point, I refer them to Gamblers Anonymous or to some local source for help. However, I have had one compulsive trader among my clients. He's now in my Super Trader program. I've simply channeled his compulsiveness from the markets into working on himself. I'm not sure that correcting trading problems is always the answer, though. For example, one approach to teaching a class on trading would be to give everyone the fundamentals in the first session and a simple trading system in the second. You could then spend the remaining sessions dealing with their problems trading that system. That would probably be a very effective class. On the other hand, you could conduct the same class by giving them the fundamentals. Then you might give them the beliefs, mental states, and mental strategies necessary to trade the system. Finally, you might give them the system. I'm willing to bet that the second method would be more effective than the first. At least that is the direction I'm heading. Talk about the origins, concepts, and direction of your Super Trader program. It all began on Christmas Eve one year when that one trader called and told me that he had made $650,000 in the 2 months since I had finished working with him. In a sense, I felt that we had only started working together. The more I thought about it, the more the question kept popping into my mind: what if we pushed this to the limits, what is he capable of accomplishing? So the idea of the Super Trader program was born from those thoughts. I called him up and suggested the idea to him. Naturally, he was all for it. About 4 of my clients have now graduated to the Super Trader program. It simply means that I continue to work with these people on a regular basis, usually semi-annually. The idea is to stretch their performance to the limits. Many people aren't ready for that, but I have enough among my clients who are. Who knows, in 3 or 4 156 years, I might just have about 50 top traders that I work with on a continual basis. Incidentally, I find that my best clients now make excellent models to use to study top traders. I sometimes have dreams which involve impending market direction. Although these are rather infrequent, they prove right a high percentage of the time. Is this unusual? I imagine that it's quite common because people tell me that all the time, especially top traders. For example, both the mechanical and intuitive super traders that we talked about earlier expressed that they had dreams about the market that were amazingly accurate. But most traders say that such dreams are infrequent enough so that they could not trade on them regularly. This phenomenon may even occur more frequently than one might imagine in symbolic form. But most people do not bother to interpret their dreams, so they miss the symbolic predictions. However, I must admit that although it interests me, I have not investigated this area very extensively. I know of lots of people of genius level who claim that some of their creativity comes from their dreams. Michael Jackson claims he doesn't write his songs, they just come to him. Paul McCartney said that he heard the song yesterday in a dream. Einstein essentially dreamed the theory of relativity. I think there are probably a lot of famous examples of this sort. It all boils down to what intuition really is, but don't ask me to explain it. I don't understand it yet. I assume that the reason you have not tried trading again is that you perceive that it would interfere with your objectivity in dealing with your clients. Yet, given all that you have learned about successful trading during the past 5 years, I imagine there must be some temptation to try it again. How do you handle this conflict? What do you envision as the long-term resolution? There are two reasons I don't trade. The first is the reason you mentioned about objectivity with clients. If I'm helping someone trade and I have conflicting positions, then I may not be very objective about what they are doing. An equally important reason, however, is that I am fully committed to doing what I am doing. I love helping other people, writing, giving talks, and so on. I'm very happy doing that. It is also a 60-hour per week job right now. If I wanted to start trading, then I would have to devote almost as much time to doing that, at least at the beginning. Why should I do that and give up what I already know I love doing? Player coaches, in the history of most sports, usually are not that effective at either coaching or playing. Your question also assumes that I am committed to trade, and as a result, there is a conflict. Actually, I find that as I get more and more into helping others become successful, I have less and less interest in trading myself. I'm investing in myself and in my business right now. I constantly work at improving my skills and knowledge, and that is paying off form. Why should I dilute that effort? Perhaps sometime in the future I will decide that I have done everything I can do, or perhaps I'll want to change what I'm doing, or perhaps I'll just want a break. For example, 3 to 4 years from now I might just be working with 50 or more top quality traders. If that happens, then maybe I'll also trade. But for the near future, it doesn't seem very likely. 157. The trade, a personal experience. In the course of conducting the interviews for this book, I came to realize that one of my primary motives for the entire project was a quest for self-discovery. Although I have been a net profitable trader over the years, substantially multiplying a small initial stake on 2 separate occasions, I had a definite sense of failure about my trading. Given the extent of my knowledge and experience about markets and trading, as well as the fact that on numerous occasions I had correctly anticipated major price moves, I felt that my winnings were small potatoes compared to what I should have made. In one of my trips for this book, on one evening I was interviewed at length about my trading by Dr. Vanthar, and the very next evening I had a probing conversation about my trading with the very perceptive Ed Seikoto. This back-to-back experience caused me to focus intensely on the flaws that had prevented me from reaching what I perceived to be my true potential as a trader. As a result of this self-examination, I came to realize that one of my great errors had been failing to exploit major price moves that I had correctly anticipated. Invariably, my initial position would be far too small given the potential I perceived in such trades. This mistake was then compounded by a highly premature liquidation of the position. Typically, I would take profits on the first leg of the price move with the intention of re-entering the position on a correction. The problem was that subsequent corrections usually fell short of my re-entry points, and refusing to chase the market, I ended up watching the rest of the price move unfold while I was on the sidelines. I vowed to myself that the next time such a situation would arise, I would make a concentrated effort to come closer to realizing the true potential of the trade. I did not have to wait very long. 2 weeks later, while on a plane to Chicago to conduct some further interviews, I was thinking about my review of the price charts the previous evening. I recalled that I had come away with the distinct impression that precious metal prices were ready to move higher, even though the foreign currency markets appeared vulnerable to further price erosion. Suddenly, the trade I should have made became crystal clear. Given my combination of expectations, a trade of long precious metals and short foreign currencies would be particularly attractive. Since these markets normally move in the same direction, the combined position implied less risk than an outright long position in precious metals. I made a mental note to generate some charts on this trade at my first opportunity. The next morning I found a quote machine capable of generating price charts and sat down to evaluate various price relationships. First, I looked at the interrelationships between silver, gold, and platinum and decided that silver was my preferred buy among the metals. Then I reviewed the interrelationships between the various foreign currencies and decided that the Swiss franc appeared to be the weakest currency. Having made these two determinations, I then reviewed charts of the silver Swiss franc ratio for various time spectrums, ranging from 10 years to 1 month. This analysis led me to the conclusion that we were at the brink of a possible multi-year advance of silver relative to the Swiss franc. Although I had intended not to trade because my traveling prevented me from paying attention to the markets, the potential of the trade seemed so dynamic that I had to put on at least a base position. To be done properly, a ratio trade requires approximately equal dollar positions in each market. I quickly calculated that at the prevailing price levels, it would require approximately 3 long silver contracts to balance 1 short Swiss franc contract. I looked at a short-term chart of the silver Swiss franc price ratio. To my dismay, the price ratio had already moved sharply in the direction of my intended trade since my realization about it the previous morning. Even on that morning's opening, the trade could have been implemented at much more favorable price levels. As I was trying to decide what to do, the silver Swiss franc ratio continued to move higher and higher. I decided that I had to act to prevent the possibility of missing this trade altogether. I immediately called in an order establishing the minimum position of long 3 silver contracts and short 1 Swiss franc contract. No sooner had I placed the order than the price ratio seemed to reach its peak and began retreating. The ratio pulled back further during the next 2 days. As it turned out, I had managed to implement the trade at the exact worst possible moment in time since the inception of my idea. However, the silver Swiss franc price ratio quickly recovered, and a few days later I was well ahead. At this point, I thought about my recent realization regarding my continued failure to adequately profit from major price moves. I decided to maintain my position and, moreover, selected a reaction point for doubling up the position. The correction came about a week later, and I followed my game plan. My timing proved good as the trade once again rebounded in my favor, this time with double the initial position. Given my account size approximately $70,000 at the time, the long 6 silver short 2 Swiss franc position was about twice as large as the one I normally would have held. My efforts to correct my aforementioned trading flaw seemed to be paying off as the trade raced in my favor during the following 2 weeks. Within a month of putting on the trade, my account was up over 30%. I now faced a dilemma. On the one hand, my new-found realization suggested that I hang on to the trade for the long run. On the other hand, one of my other rails is that if you are ever lucky enough to realize a very large profit on a trade very quickly, take it, because you will usually get an opportunity to re-enter the trade at considerably more favorable levels. The second rail came to mind when the silver Swiss franc price ratio began falling. A cursory examination of the price charts suggested it might be prudent to take at least partial profits. I should have done more analysis to reach a decision. However, the combination of having undertaken a new job while at the same time writing this book left me with very little time and energy to focus on other areas, trading included. Instead of doing the necessary work, I made a snap judgment to stay with the trade. The trade now moved swiftly against me, and within a week I had given back a significant portion of my earlier gains. Although a week earlier I had rationalized that my substantial profits would give me enough of a comfort cushion in the event of a reaction, now that such a reaction had occurred I found that I had seriously misjudged my comfort level. Suddenly I was concerned that I might give back all my profits, and possibly even ride the trade into a 158 loss. I could not decide whether to blow out of the trade or stay with it as initially planned. That night I had a dream. I was talking to a friend of mine who is a developer of software for the analysis of futures and options markets, but not a trader. In my dream, he had begun trading. We were talking about trading and my current dilemma regarding the silver Swiss franc position. My friend commented on my predicament. Everybody gets what they want out of the markets. I replied, "You sound just like Head Seikota." This sounded a bit odd to me since, as far as I knew, he did not even know Seikota. To my surprise, he answered, "I have been talking to Ed Seikota for a while and I have been winning in my trading ever since." He had a sheet in front of him with one of the columns indicating his month-to-month ending equity. I glanced at the sheet and was astounded to see that the last figure exceeded $18 million. I exclaimed, "Bert, you have made $18 million in the market. I hope you plan to take a few million out for safekeeping." "No, I need all the money for trading," he replied. "But that is crazy," I said. "Take $3 or $4 million out, and that way you will be sure then that no matter what happens you will come out way ahead. I know what I am doing, and as long as I do my homework on the markets every day I am not concerned," he replied. His answer had implied quite correctly that I did not diligently do my homework on the markets every day. His point, although unstated, was quite clear. If I did my work on the markets every day, I wouldn't have any trouble understanding why he did not need to pull out several $1,000,000 in profits from his account to feel confident that he would not lose back all his profits in trading. You say you don't have enough time each day to do your work on the markets. You are too busy with your new job and writing your book. Here, let me show you something. He started citing assumptions regarding the sales of my book, royalties per copy sold, and the total hours I had spent writing the book. He then scribbled various calculations on a yellow pad. He arrived at a final figure of $18.50 per hour. "Here," he said, "this is what you are making on your book." The tone of his voice implied that I was crazy to jeopardize tens of thousands of dollars in my trading for such a paltry sum. Actually, the $18.50 estimate is probably wildly overinflated. But remember, this was a dream. It was no coincidence that this dream occurred the night after editing the section of the Marty Schwartz interview dealing with his diligence in doing his daily homework on the markets. I realized that there are no shortcuts. If you want to be a good trader, you have to do your work on the markets every day. If there is not enough time, you have to make time. The costs for strain from this daily discipline in terms of lost profit opportunities as well as losses can be very substantial. The message my subconscious seemed to be crying out was, if you are going to be serious about trading, you have to reestablish your time priorities. 159 160 Postscript Dreams and Trading. The relationship between dreams and trading is a fascinating subject. Readers may look up Seikota's and Tharp's comments on this matter. There was another interview in which this topic was prominently discussed. In that instance, the trader decided to rescind his approval for use of our conversation in the book. I was somewhat puzzled by his decision, since the chapter was basically complimentary. "What could you possibly have found so offensive as to back out completely?" I asked. "Absolutely nothing," he replied. "In fact, you made me sound almost human." It turned out that he was upset about his inclusion in a recently published book, and that he was adamantly opposed to his appearance in any book. Even the offer of anonymity failed to change his decision. I did, however, manage to get his permission to use the dream-related portion of the interview. The name references in the following conversation have been changed. In 1980, the year when corn set its record high, I was long the position limit. One night I had the following dream. I'm talking to myself and I say, "Hey Jerry, where is corn going to $4.15?" Where is corn now? $4.07. You mean you are taking all that risk for an extra 8 cents? Are you crazy? I woke up in a flash. I knew I had to get out of my entire corn position as soon as the market opened the next day. The next morning the market opened up a little higher, and I started selling. The market moved a little higher, and I sold more heavily. The market moved up some more. For a minute I thought the floor broker had executed my order backwards. He hadn't. Anyway, a few minutes later I'm completely out of my position and the phone rings. It's my friend Carl, another good trader who had also been long corn. He says, "Jerry, is that you doing all the selling?" I tell him, "Yes, I just got out of my entire position." "What are you doing?" he shouts. I say, "Carl, where is corn going to?" "About $4.15 minus 4.20. He replies. "Where is corn now?" I ask him. I hear an immediate click over the phone. He didn't even waste any time saying goodbye. And was that the top of the corn market? It might have gone up another day, but that was just about the high. Once it started falling, I could never have unloaded a position of my size. I found this trader's narration of his dream particularly fascinating, since I have occasionally had similar experiences. Usually I have found that when you feel strongly enough about a trade, either getting in or getting out, to dream about it, the message should be heeded. Of course, like anything else, this does not work all the time, but I believe it places the odds more in your favor. As I interpret it, the dream is the means by which our subconscious penetrates the barriers we sometimes erect in accepting the true analysis of a market. For example, if I am bullish and not in a market, I might rationalize that it is prudent to wait for a reaction before entering the trade, even if a realistic assessment would suggest that such a development is unlikely. This is because entering the market at a higher price is a confirmation that, to some extent, I have already failed, that is, by not buying sooner, a distasteful acknowledgement. In such a case, a dream that the market was going to run away on the upside might be the subconscious way of breaking through mental impediments. 161. Final word: there is no holy grail to trading success. The methodologies employed by the market wizards cover the entire spectrum from purely technical to purely fundamental and everything in between. The length of time they typically hold a trade ranges from minutes to years. Although the styles of the traders are very different, many common denominators were evident. One, all those interviewed had a driving desire to become successful traders, in many cases overcoming significant obstacles to reach their goal. 2, all reflected confidence that they could continue to win over the long run. Almost invariably, they considered their own trading as the best and safest investment for their money. 3, each trader had found a methodology that worked for him and remained true to that approach. It is significant that discipline was the word most frequently mentioned. 4, the top traders take their trading very seriously. Most devote a substantial amount of their waking hours to market analysis and trading strategy. 5. Rigid risk control is one of the key elements in the trading strategy of virtually all those interviewed. 6. In a variety of ways, many of the traders stressed the importance of having the patience to wait for the right trading opportunity to present itself. 7. The importance of acting independent of the crowd was a frequently emphasized point. 8. All the top traders understand that losing is part of the game. 9. They all love what they are doing. 162. Appendix 1. Program trading and portfolio insurance. One subject that has received widespread publicity in recent years is program trading. Perhaps never in the history of financial markets has there been more criticism about a trading approach that was less understood. I would venture a guess that less than 1 out of 10 people opposed to program trading even know the definition of the term. One source of confusion is that program trading is used interchangeably to describe both the original activity and as a more general term encompassing various computer-supported trading strategies, for example, portfolio insurance. Program trading represents a classic arbitrage activity in which one market is bought against an equal short sale in a closely related market in order to realize small, near risk-free profits, resulting from short-lived distortions in the price relationship between such markets. Program traders buy or sell an actual basket of stocks against an equal dollar value position in stock index futures when they perceive the actual stocks to be underpriced or overpriced relative to futures. In effect, program trading tends to keep actual stock and stock index futures prices in line, insofar as every program-related sale of actual stocks is offset by a purchase at another time, and most program trades are first initiated as long stock short futures positions because of the optic requirement in shorting actual stocks. Arguments that program trading is responsible for stock market declines are highly tenuous. Moreover, since the bulk of economic evidence indicates that arbitrage between related markets tends to reduce volatility, the relationship between increased volatility and program trading is questionable at best. Portfolio insurance refers to the systematic sale of stock index futures as the value of a stock portfolio declines in order to reduce risk exposure. Once reduced, the net long exposure is increased back toward a full position as the representative stock index price increases. The theory underlying portfolio insurance presumes that market prices move smoothly. When prices witness an abrupt, huge move, the results of the strategy may differ substantially from the theory. This occurred on October 19, 1987, when prices gapped beyond threshold portfolio insurance sell levels, triggering an avalanche of sell orders which were executed far below the theoretical levels. Although portfolio insurance may have accelerated the decline on October 19, it could reasonably be argued that the underlying forces would have resulted in a similar price decline over a greater span of days in the absence of portfolio insurance. This is a question that can never be answered. It is doubtful that program trading, as defined above, played much of a role in the crash of the week of October 19, since the severely delayed openings of individual stocks, tremendous confusion related to prevailing price levels, and exchange restrictions regarding the use of the automated order entry systems severely impeded this activity. 163 Appendix 2. Options understanding the basics. There are two basic types of options, calls and puts. The purchase of a call option provides the buyer with the right but not the obligation to purchase the underlying item at a specified price, called the strike or exercise price, at any time up to and including the expiration date. A put option provides the buyer with the right but not the obligation to sell the underlying item at the strike price at any time prior to expiration. Note, therefore, that buying a put is a bearish trade, while selling a put is a bullish trade. The price of an option is called a premium. As an example of an option, an IBM April 130 call gives the purchaser the right to buy 100 shares of IBM at $130 per share at any time during the life of the option. The buyer of a call seeks to profit from an anticipated price rise by locking in a specified purchase price. The call buyer's maximum possible loss will be equal to the dollar amount of the premium paid for the option. This maximum loss would occur on an option held until expiration if the strike price was above the prevailing market price. For example, if IBM was trading at $125 when the 130 option expired, the option would expire worthless. If at expiration the price of the underlying market was above the strike price, the option would have some value and would hence be exercised. However, if the difference between the market price and the strike price was less than the premium paid for the option, the net result of the trade would still be a loss. In order for a call buyer to realize a net profit, the difference between the market price and the strike price would have to exceed the premium paid when the call was purchased after adjusting for commission cost. The higher the market price, the greater the resulting profit. The buyer of a put seeks to profit from an anticipated price decline by locking in a sales price. Like the call buyer, his maximum possible loss is limited to the dollar amount of the premium paid for the option. In the case of a put held until expiration, the trade would show a net profit if the strike price exceeded the market price by an amount greater than the premium of the put at purchase after adjusting for commission cost. Whereas the buyer of a call or put has limited risk and unlimited potential gain, the reverse is true for the seller. The option seller, often called the writer, receives the dollar value of the premium in return for undertaking the obligation to assume an opposite position at the strike price if an option is exercised. For example, if a call is exercised, the seller must assume a short position in the underlying market at the strike price, since by exercising the call, the buyer assumes a long position at that price. The seller of a call seeks to profit from an anticipated sideways to modestly declining market. In such a situation, the premium earned by selling a call provides the most attractive trading opportunity. However, if the trader expected a large price decline, he would usually be better off going short the underlying market or buying a put trades with open-ended profit potential. In a similar fashion, the seller of a put seeks to profit from an anticipated sideways to modestly rising market. Some novices have trouble understanding why a trader would not always prefer the buy side of the option, call or put, depending on market opinion, since such a trade has unlimited potential and limited risk. Such confusion reflects the failure to take probability into account. Although the option seller's theoretical risk is unlimited, the price levels that have the greatest probability of occurrence, i.e., prices in the vicinity of the market price when the option trade occurs, would result in a net gain to the option seller. Roughly speaking, the option buyer accepts a large probability of a small loss in return for a small probability of a large gain, whereas the option seller accepts a small probability of a large loss in exchange for a large probability of a small gain. In an efficient market, neither the consistent option buyer nor the consistent option seller should have any significant advantage over the long run. The option premium consists of two components: intrinsic value plus time value. The intrinsic value of a call option is the amount by which the current market price is above the strike price. The intrinsic value of a put option is the amount by which the current market price is below the strike price. In effect, the intrinsic value is that part of the premium that could be realized if the option were exercised at the current market price. The intrinsic value serves as a floor price for an option. Why? Because if the premium were less than the intrinsic value, a trader could buy and exercise the option and immediately offset the resulting market position, thereby realizing a net gain, assuming that the trader covers at least transaction costs. Options that have intrinsic value, i.e., calls with strike prices below the market price and puts with strike prices above the market price, are said to be in the money. Options that have no intrinsic value are called out-of-the-money options. Options with a strike price closest to the market price are called at-the-money options. An out-of-the-money option, which by definition has an intrinsic value equal to zero, will still have some value because of a possibility that the market price will move beyond the strike price prior to the expiration date. And in the money option will have a value greater than the intrinsic value because a position in the option will be preferred to a position in the underlying market. Why? Because both the option and the market position will gain equally in the event of a favorable price movement, but the option's maximum loss is limited. The portion of the premium that exceeds the intrinsic value is called the time value. The three most important factors that influence an option's time value are a relationship between the strike and market price. Deeply out of the money options will have little time value, since it is unlikely that the market price will move to the strike price or beyond prior to expiration. Deeply in the money options have little time value because these options offer positions very similar to the underlying market. Both will gain and lose equivalent amounts for all but an extremely adverse price move. In other words, for a deeply in the money option, the fact that risk is limited is not worth very much because the strike price is so far from the prevailing market price. Time remaining until expiration. The more time remaining until expiration, the greater the value of the option. This is true because a longer lifespan increases the probability of the intrinsic value increasing by any specified amount prior to expiration. Volatility time value will vary directly with the estimated volatility, a measure of the degree of price variability of the underlying market for the remaining lifespan of the option. This relationship is a result of the fact that greater volatility raises the probability of the intrinsic value increasing by any specified amount prior to expiration. In other words, the greater the volatility, the greater the probable price range of the market. 164. Although volatility is an extremely important factor in the determination of option premium values, it should be stressed that the future volatility of a market is never precisely known until after the fact. In contrast, the time remaining until expiration and the relationship between the current market price and the strike price can be exactly specified at any juncture. Thus, volatility must always be estimated on the basis of historical volatility data. The future volatility estimate implied by market prices, i.e., option premiums, which may be higher or lower than the historical volatility, is called the implied volatility. Adapted from Jack D. Schwager, A Complete Guide to the Futures Market, John Wiley & Sons, New York, NY, 1984.